Hello, good afternoon, everyone. Welcome to the training session today. Great to have you joining us. So we'll be getting started in just a moment with the training session. But before we do, please take a moment to find your settings, make sure you've got your audio sorted. Feel free to introduce yourselves in the chat as well. If you'd like to say hello and let us know what organization you're joining us from as well. I see lots of you joining us quickly in the session, which is fantastic to see. So big welcome, everyone, and we'll be getting started in just a moment. Okay, hi everyone. Welcome to those who've just joined us in the session. Great to have you with us here today. And thanks for saying hello in the chat, everyone. Great to see what organizations you're joining us from. So I think we have many of us here already. So in the interests of time, we'll get started with the session. So a big welcome to this half-day training on applying the IFRS Sustainability Disclosure Standards. This programme is truly a collaborative effort, and we'd like to say a big thanks firstly on behalf of the UNSSE to our colleagues at the IFRS Foundation, at the IFC World Bank Group, and also at the Bursa Malaysia, of course, in particular today for hosting this session with us. And last but not least, of course, a big thank you to all of you for taking the time out of your day to join us at the training session. So to get us started with our session today, I'm very pleased to be joined by two colleagues who are going to be giving us some opening remarks to set the scene for today's session. So firstly, I'm very pleased to introduce Dr. Yo Ken Kyud, who is Director of Group Sustainability at the Bursa. So a big thanks for joining us, Ken, and the floor is yours.
Fantastic. Thank you very much, Fiona. Very good afternoon to the UNSSC team, IFRS facilitators, and also to all of you workshop participants who are here with us today. Of course, my name's Ken, and I'm Bursa's Director of Group Sustainability. Now, as we are preparing our own ISSB disclosures for FY 2025, we can deeply appreciate both the relevance and also timeliness of this workshop on the IFRS sustainability standards, especially for our fellow Group 1 PLCs who are reporting in alignment with the standards for the very first time. So therefore, it gives us great pleasure to host this workshop in collaboration with UNSSE and facilitators from the IFRS Foundation. I'm certain that participants will gain a lot of valuable insights into the practical application of the ISSB standards, especially given some of the latest developments, be it guidance, practical examples, as well as emerging practices. Now, without further ado, of course, I would like to pass the floor over back to the UNSSE team, and I wish everyone a productive workshop ahead. Thank you.
Brilliant. Thank you so much for that, Ken. And it's fantastic to hear as ever about the Bursa Malaysia's great ambitions on this topic and to hear of your efforts as well to report alongside your issuers. So fantastic. Thank you for that. And secondly, I'm very pleased to welcome as well Judith Green from the World Bank Group. Judith is the country manager for Malaysia at the World Bank. And thanks for joining us, Judith. And I'll pass over to you now as well.
Thanks a lot. Good afternoon, everybody. And I join, Dr. Ken in being delighted to be here with all of you today. I mean, over the last few years, there's been a significant surge in demand for sound ESG data and disclosure. And so the launch of the IFRS Sustainability Disclosure Standards and the European Sustainability Reporting Standards in 2023 have brought a long-anticipated convergence of sustainability disclosure frameworks. As Dr. Ken said, today's training is really a result of the partnership between ourselves at IFC, the UN Sustainability Stock Exchange Initiative, and the IFRS Foundation, which aims at strengthening capital markets by enhancing sustainability and climate reporting in emerging markets and developing economies. I'm sure you're going to hear later about IFRS Sustainability Disclosures S1 and S2, and how these new standards reflect the increased sustainability and climate reporting requirements. What they do is they urge regulators and stock exchanges globally to adapt to their listing requirements and reporting guidelines to meet investor demands for sound ESG data. So we are really, really pleased to be a part of this initiative. In Asia Pacific, we've been able to partner with Bangladesh Bank for the development of their guidelines on sustainability and climate-related financial disclosure. And we are also working with banks in Mongolia, regulators in Mongolia and in Nepal. So we also provide a lot of training, similar training across the region to a wide range of stakeholders, in addition to providing advisory services to financial intermediaries and rail sector clients to align with international standards. I want to briefly mention that in Malaysia, the World Bank has actively supported regulators in strengthening the country's sustainability disclosures. In 2024, last year, we worked with SC Malaysia to jointly launch the ESG Disclosure Benchmarking Report, which identifies gaps in environmental disclosures in Malaysia and provided targeted recommendations to enhance market practices. We've also worked on with SC on their SRI taxonomy, which is also a very important area. Finally, we've also help focus how international capital is focused on these sustainability opportunities. The new EU regulations, such as the regulation of deforestation-free products, offers opportunities if businesses in Malaysia can demonstrate compliance. So by adopting ESG practices, businesses can also mitigate various types of risks, including in the current international environment, which is characterized by policy uncertainty. In Malaysia, World Bank figures show that even though comprehensive ESG monitoring and reporting remain limited, many large businesses are actively seeking to improve their ESG performance, often going beyond what they monitor and report. A key milestone in this transition is Bursa Malaysia's requirement for listed companies to start reporting sustainability-related risks and opportunities. I believe that happened in January this year. And Dr. Ken just mentioned the fact that the larger firms are the ones that are starting with this. So I really want to congratulate Malaysia and Bursa Malaysia for this first step forward. Just to round out my remarks, I want to also introduce everybody to the IFC Beyond the Balance Sheet platform, which is a valuable new resource. I think the link will be put in the chat, and it will also be in the training materials. The platform offers a step-by-step toolkit for preparing reports that align with IFRS and other global standards. We continuously update this platform, so I encourage you to look at it and see if it supports, the work that you do. I want to also endorse Dr. Ken on today's session because I do feel that it will strengthen your understanding of the standards to be discussed and in the end support your work in advancing sustainable finance. I want to thank Dr. Ken and Bursa Malaysia for hosting this event, as well as to thank the UN SSE team for inviting me to deliver these opening remarks. I hope you enjoy today's event. I hope you actively participate. And as we say here in Malaysia, terima kasih. Thank you.
Brilliant. Thank you so much for that scene setting there, Judith, and great to have you with us in the session. I have shared the link in the chat to Beyond the Balance Sheet, and we'll come back to that at the end of the session as well. And as you say, fantastic resource there for companies. So many thanks for highlighting that. Brilliant. Thank you so much, Judith, and to Dr. Ken for opening the scene and setting the scene for us so well there in the session. So without further ado, I'm going to move into giving you a little bit of an overview of what we're going to cover in today's training and how the session works before we get started. So firstly, just a few quick housekeeping points. So you've probably noticed by now that as participants, you are muted in the session, but that isn't to say that we don't want you to participate and engage with us. So it's great to see so many of you already using the chat function to do so. And if you have particular questions for us as we move through the training session, I'd encourage you to please post those in the Q&A box as well, because obviously the chat can move quite quickly, whereas if we have the Q&A box, we can keep a track of all of our questions there. It's just to say as well, I know that you may have some particular questions today that relate specifically to the NSRF in Malaysia. And if you have those kinds of questions, we've been given a contact route for the Bursa to raise those. So my colleague Lois will share the details details for how to get in touch with the team with those sorts of questions, and we can continue to share that throughout the session as well. But we'll do our best today with our colleagues from the IFRS to answer your questions as they relate to the standards as a whole. And of course, the Bursa's approach is closely aligned with those standards, so hopefully we should be in a good position to help you there. So in terms of our format today, we have a live 3.5 hour session with an optional follow-on homework activity as well. As I've said, there's live Q&A throughout, so please take that opportunity to ask us your questions. And for those of us who are not presenting at the time, we'll do our best to type our answers in the background to respond to you. As Judith already mentioned, we really do encourage your participation in the session as well. So we're going to be using a number of interactive tools during the training, including Menti and the polls within Zoom. So encourage you to take part in all of those opportunities to participate and help you to deepen your learning as you move through the session as well. And finally, if you take part in the training live with us today, you're also able to receive a CPD certified completion certificate. To get your survey feedback, we need to get a feedback survey from you that will allow you to get your certificate. So we're going to give you instructions at the end of the training about how to get your certificate. So stay tuned for more about that towards the end. And so just to say a quick introduction to who's going to be delivering the training for you today. So firstly, I'm Fiona Quinlan-Wells from the UN SSE team, and I'm joined by my colleague Lois Guthrie, our senior specialist. Hi, Lois. And alongside us today, we're pleased to be joined by our colleagues from the IFRS capacity building team as well. So firstly, Vanessa Hay will be presenting with us shortly, and then later in the session, we'll also be joined by her colleague Robert Swiatowski as well. And both Vanessa and Robert will be available to support with answering your questions too. And in terms of what we're aiming to cover with you today, we've got 3 key learning objectives that we'd like to help advance. So firstly, we'd like to help you to understand the ISSB standards. Secondly, to think about how you can use the ISSB standards and put them into practice in your organizations. And then finally, we'd like you to identify the steps that you'll be able to take to develop your own disclosure plan to apply the ISSB standards. And so to help us meet those 3 objectives, we've developed our agenda for today's training session, which we've broken down into that circular diagram that you see on the screen. So keep in mind as we move through our session today that these are the 4 different areas we're going to be moving through. So firstly, we're going to start with prepare. So this is all around building on any existing knowledge that you might have of sustainability reporting and thinking about how reporting has evolved in recent years to reach the baseline of the ISSB standards. We're then going to move into align. And so that's all around setting the direction for your own reporting. So thinking about how you can apply and use the standards and any additional disclosures that you might also need to add to meet your geography or sectoral requirements as well. That will then bring us into our 3rd module, implement, which is all around your internal practices and systems. So thinking about how you can put in place the right actions internally to identify, evaluate, and integrate those risks and opportunities that you'll be reporting on. And then we're going to finish with communicate. So this is all around the final format for your reporting. So thinking about the location of where you should report, the timing of when you should do so, and how to do so with efficiency and confidence for your stakeholders as well. And just to show you that another way, this is how the timing for our session breaks down across the different units. So in the middle of our 2nd module there, we'll also take a short break to help you refresh during the session. And we'll wrap up at the end with some time to cover off the homework and some additional resources as well. And so just to mention, for the materials from today's session, we know that sometimes it can be helpful to revisit the slides or to find some of the links that we share with you. So as Lois has already shared in the chat with you, and we'll share it a number of more times through the session, if you go to the event page for today's session and go to resources at the bottom, you'll be able to find the slide handout from today's training session and the homework exercise as well. And we'll be sharing a number of links with you in the chat during the session. You'll be able to find the hyperlinks to all of those resources on the relevant slides in the handout as well. So make sure to check that out on the webpage. And I think someone has already asked this question, but just to confirm, we are recording today's training as well. And that recording will be added to the same page after the training. So you can take a look there if you'd like to revisit any of the content later after the training as well. Okay, and as I've mentioned, from that page, you can also access the optional homework assignments. So as I said, this homework is a voluntary thing. It's not mandatory for you to complete this, and there's no need for you to submit this to us. But the idea of the homework is to help you to develop that draft disclosure plan for your company, to put into practice what you've learned in the training program. So you can find the link to that on our event page under resources. And as I've said, really the aim for the homework is to help you to build on the experience from today's session and hopefully to take this forward with your colleagues as well. And just to mention a number of other key resources from the UNSSE that can support you in your reporting journey. So we've developed the UNSSE toolkit and worked really closely with the IFRS team to develop the resources that you see on the screen here, which can support you across the topics of sustainability disclosure, talking about some of the specifics of climate change, and also thinking about how to conduct a gap assessment of your existing disclosure practices against the IFRS standards as well. So you can follow the QR code there if you'd like to take a look at these resources. Okay, so with that, it's time for our first interactive element of the training session. So for our interaction today, we're going to be using Mentimeter. And the main way that you can access Menti is that my colleague Lois will be sharing a link with you in the chat that will take you straight to our first question. So would encourage you to follow that link and we can take part in this exercise together. But what I will do now is I'll share my screen as well, and that will give you another couple of options for how you can join us in Menti too. Great, so Lois has just shared that link there. Thanks, Lois. So that's probably the easiest way to access Menti, just to follow that link, and that will take you straight to your first question. But two other options that you have is to use that QR code that you'll see in the bottom right of my screen now. And also, if you go directly to menti.com, if you see that black box at the top of my screen with the 8-digit code in, you can enter that code in Menti there as well to take you through to the question. But just to get us started, our first question today is to share in your own words with us why you've joined us in today's training. You know, what are you most interested in, or what do you want to get out of today's session? Great, I see lots of you have already found your way to Menti, so that's fantastic. Thanks, everyone. So I see lots of different words coming in, but I'm seeing compliance coming in top. So front of mind, I guess, the need to comply with your reporting requirements and to help you in doing that. So, of course, very understandable. I'm seeing disclosure, knowledge, insights, learning, curiosity, implementation, sustainability, maybe learning from the IFRS team. Fantastic. Lots of great objectives and hopefully all things that we are well aligned with supporting for our format for today. So thanks everyone, and great to have so many of you taking part. Okay, so our second question, which I'll just move on to now, is just to get a sense from everyone as to what your current understanding and comfort is with the different objectives that we have from today's session. So you can use that sliding scale that you'll see there to let us know from the left-hand side, maybe you're a beginner, you're just starting out on these topics. To the right-hand side, maybe you're actually quite familiar and knowledgeable on this already. And let us know how you're feeling about your current understanding on explaining to your team members what the ISSB is, on using the ISSB standards, and on developing a sustainability reporting strategy. Okay, so I see the responses coming in already. Just give everyone a moment more to respond, but it looks like overall, most people are sort of somewhere in the lower to middle end of sort of confidence and understanding on these topics already. Most people kind of the distribution between right at the beginning and then somewhere above middle in comfort. So that's great to understand where everyone's at today before we get started. And we'll come back and revisit that at the end of the session as well to see if we've hopefully helped to improve your knowledge and understanding there as well. Fantastic. So would recommend to keep that Menti link open in the background, because we'll revisit Menti again a number of times throughout the session at the same link that you've got there. But for now, I'll take us back into the presentation and we'll get started with a bit of introductory content in our first module. So just to begin with, I've got a quick disclaimer that I need to share with you that I'll give you a moment just to review here. And really the purpose of the disclaimer is just to be clear with you how we're going to be using company disclosure examples in today's training. These are really simply here to add some colour to what we're talking about, because we know, of course, seeing a real example can often be helpful to understand how to put into practice what we're discussing. However, the examples that we share shouldn't be seen as the best or the right way to approach this. Of course, each company's circumstances are unique, so we recommend that you, of course, approach disclosure in the way that's right for your organizations. But hopefully that can help you to share some examples as we move through the training. Okay, so with that established, I'll get us started on our first unit, which is prepare. And as I've said before, this is all around building on your building a solid foundation of knowledge on sustainability disclosure practices. And so there's three aspects that we particularly cover in this first unit. So we start with purpose. So this is thinking all around the case and purpose of sustainability reporting, including what the market and business case for disclosure might be. We're then going to move into landscape. And so this is thinking about how the reporting landscape has evolved and how it's becoming simplified. And then we'll finish off with the global baseline. So that will be introducing you to the core concepts and requirements of the IFRS S1 and 2 standards that form that global baseline. Okay, so getting started on the purpose side of things, let's kick off with getting a sense from you all as to what your key reasons are for disclosing or being interested in the disclosure of sustainability related financial information. So I've just launched the poll for you there, and you can select as many of these options as are relevant for you, but let us know, what are your top reasons for thinking about this topic? Is it about regulation? Maybe is it sharing your own management or organization's objectives publicly? Maybe this competitor or peer pressure to disclose amongst other companies, perhaps investor interest. Maybe you have other reasons as well, so feel free to share those in the chat if there's anything we've missed there. And of course, for some of you, of course, you may not be disclosing yet, and you might just be getting started joining us in the training today, which is fine as well. So I'll give you all a moment or two to answer that before we take a look at those results together. Brilliant. Thanks everyone for taking part in the poll. Always great to have lots of responses from the audience. So thanks everyone. I see Amelia's answered in the chat with another reason as well, which is relating to B Corp certification as well. So that's interesting to see. Thanks for sharing that, Amelia. And Suresh has mentioned outside in impacts as well. So yeah, thinking maybe about your impacts that might be, I don't know if you mean outside in impacts, apologies. Yes, I see what you mean. So maybe the risks that your organization faces that you need to respond to, which is a good point to raise. Okay, so I'll end the poll there and share those results with you. So it seems maybe a little unsurprisingly from your Menti responses that regulatory requirements is your top driver, which is very common that we see that answer across many markets now as we are moving towards more mandatory disclosure practices. But quite a few of you as well, more than half, have also shared that investor interest in this topic is a key driver as well. So that's really interesting to see. So thanks everyone for sharing your responses with us there. Okay, so I'll just close that poll down. And so moving on now to the next area of focus, we want to talk about some of those different drivers. So a lot of you mentioned there that investor interest as well as regulation was a key driver. And I think that is something that we'd really like to highlight at the start of the session, because of course, the purpose of the IFRS standards is to respond to that investor angle and ensure that investors have the type of disclosure they need to manage sustainability risks and opportunities in their portfolios. And so I think one measure easy measure to look at for this and that growth in investor interest is the number of signatories that we see globally to the Principles for Responsible Investment, which now stands at over 5,000 signatories globally, representing more than 128 trillion US dollars in assets under management. So we can see overall in the last 5 years or so, there's been a strong uptick in interest from investors in these sorts of issues. And so what is it that we think is really driving that investor interest? What I think we'd like to highlight is that a key driver behind this demand from investors is indeed the financial effects of sustainability risks and opportunities. So this data that we're showing you here comes from a study of retail investors, which was conducted by Morgan Stanley. And where in this study, they found that at least for these individual investors, the top driver that was driving their interest in sustainability was the financial performance of sustainable investments. So it's not necessarily just something that impact investors want to focus on anymore. But of course, the mainstream financial community really understand that sustainability factors can have a financial effect. And so before we move on, I want to also explain there what we might mean by financial effects and financial performance, because those are going to be some terms that we use a number of times during the session. So it's important to remember overall that our focus in the training today is going to be about the disclosure of financially material sustainability information. So we're going to talk a bit later in the workshop about what the word material means in the IFRS context, but we want to be clear from the start about the sorts of financial effects that we're looking to have information on. So starting with effects on a company's financial performance, we often see this in the profit or loss statement. And sustainability risks and opportunities can have a financial effect, for example, by potentially changing the total revenue mix or mix of revenue of the organization, maybe if a demand for a company's products and services change. And they can also lead to changes in expenditure as well. So we could see, for example, increased operating costs if energy prices rise, or if there's a need to invest in mitigation measures to manage risks such as extreme weather events. And the other type of financial performance effect that we see is effects on financial position. So this is the reflection that comes across in the organization's balance sheet or statement of financial position. And so, for example, this could be related to a company seeing changes in certain assets or liabilities due to climate or sustainability issues. For example, if we might see write-offs of certain assets that need to be damaged as a result of climate issues or that need to be repriced. And we can also see changes to the cost of capital as well. For example, changes in insurance premiums, or maybe also access to new financing structures such as green bonds as well. And so before we move into our next unit, two really important final concepts to finish on this introductory module with. So firstly, just talking about the nature of sustainability risks and opportunities. And as you can see here from the global risk survey conducted each year by the World Economic Forum, the types of risks that we're focused on a near-term timeframe can be very different from those risks that we think about over the long term. And actually, it's over the long term that we expect to see many of the sustainability risks and opportunities materializing. But what we also need to keep in mind is even if the impact of a risk is only expected to occur in a longer term timeframe, if we need to take action now to mitigate that risk or perhaps capitalize on the opportunity, we could see financial effects on a nearer term basis as well. So that's something that we need to think about, plan for, and disclose in our reporting. And finally, another concept just to highlight in this section is the interconnectivity of these different types of risks. So another visual here that draws from this WEF report shows how interconnected the different types of ESG and broader business risk type are. So of course, in our reporting standards, we might think about these issues as separate topics, but it's not to say, of course, that we don't need to think about those interconnections across different sustainability issues. And when we're disclosing on these issues, we should be doing our best to acknowledge and to explore those different interconnections as well, where it's relevant to. Okay, fantastic. So that is the end of our purpose section of prepare. And I'm going to hand over to Lois now, who'll get us going with the landscape section.
Thank you, Fiona, and hello, everybody. Well, we've briefly covered now why sustainability disclosure is important, and now we're going to look at how the IFRS sustainability disclosure standards developed in the landscape of existing reporting standards. But first of all, we'd like to do a Zoom poll with you again to ask you which reporting frameworks you're currently using. So please select all that apply. Are you using the Global Reporting Initiative standards, the Integrated Reporting Framework, the Sustainability Accounting Standards Board standards, the recommendations of the Task Force on Climate-Related Financial Disclosure, regional standards, of course, that we've heard about from colleagues earlier, that apply to companies in your region or others? Please tell us in the chat if there are others or none. Give you a few moments to think about that. Thank you to so many of you for participating, and let's end the poll and I'll share the results with you. So you can see that many of you are using the Global Reporting Initiative's standards. That's followed by organisations using the recommendations of the Task Force on Climate-Related Financial Disclosure, and then sort of in equal numbers of organisations using the Integrated Reporting Framework and the SASB standards. And of course, many of you are using NSRF as well at the moment. Thank you for telling us that in the chat. So let's go on now to look at what the IFRS Foundation is and how the ISSB came to be. Well, the IFRS Foundation is a not-for-profit public interest organisation that was established to develop high-quality, understandable and enforceable globally accepted accounting and sustainability disclosure standards. At the bottom of the screen, we see that the Foundation hosts two independent standard-setting boards, the International Accounting Standards Board that was formed in 2001 and has developed financial reporting standards that are in place in over 140 jurisdictions around the world. The sister board, the International Sustainability Standards Board, was formed in 2021 and released its first two standards in 2023, following strong market demand for them. So because the two standard setting bodies are within the same foundation, they work closely together to ensure that their standards complement each other. And governance of these standard-setting boards is provided by IFRS Foundation trustees, who are in turn accountable to a monitoring board of public authorities. So how did all this come to be? Well, of course, you'll recognise many of the logos on this screen, I know, and these are the logos of organisations that have all contributed to the evolution of sustainability reporting. Although they've sometimes been called an alphabet soup and a bit of a confusing picture, actually they share lots of objectives and content requirements. But this is a picture really rather of confusion. It's a picture of harmonization and simplification that is indicated by the arrows you see on the screen. So the Transition Plan Task Force that develops transition plan guidance and requirements has now been incorporated into the IFRS Foundation, and the ISSB is responsible for disclosure-specific materials of the TPT. Similarly, with TCFD, their work has now culminated, the TCFD has disbanded, and the TCFD recommendations are now reflected in the ISSB standards. The standards were built on the TCFD recommendations. The three organisations you see at the bottom of the screen, the CDSB, Integrated Reporting and SASB, those organisations have been consolidated into the IFRS Foundation right from the beginning. CDP has aligned its climate questionnaire with IFRS S2 on climate disclosure, and GRI is working really closely with the ISSB to ensure that they identify and align common disclosures. So a picture of harmonisation and simplification. Now let me ask you a Zoom question, please, to see what we make of this. And the question is, companies that disclose using the TCFD recommendations automatically comply with the ISSB standards. Is this true or false? Great to see so many of you participating. Oh, now we've got a good level of participation. Let's have a look at what you think. So 60% of you said false and 40% said true. Well, those of you that said false are correct. So well done. Many audiences we asked this question to get this wrong because as we've told you, the ISSB standards were built on the TCFD recommendations, so could quite understand why you might say true, but it is false, and we'll just explain why now. Although the ISSB standards have been built on the TCFD recommendations, as I've just said, the TCFD has culminated its work. But although there's a lot of similarities, and if you know the TCFD recommendations, the ISSB standards will look very familiar to you, there are some differences which are outlined in the document you see on your left. There are really three main types of differences. First of all, S2 uses different wording than TCFD, but to capture the same information. Secondly, S2 might require more detailed information than is in the TCFD recommendations. So this might be something like requiring companies to explain why and the extent to which they use carbon credits to satisfy their targets, carbon reduction targets. And thirdly, S2 provides some additional requirements and guidance, and an example here is that S2 requires companies to consider sector-specific disclosures. Now, there's been global backing for the ISSB's objective, which is to set a global baseline for sustainability information. That global baseline actually fulfills the objective of the ISSB, and it's designed to enable comparable and consistent sustainability disclosures across global capital markets. It provides a common language for this comparable, decision-useful disclosure that's designed to meet investor needs. But of course, the Foundation knows from working with jurisdictions around the world that there may be jurisdiction-specific requirements and broader multi-stakeholder information needs that companies want to or have to report on and make disclosures about. So that on top of the global baseline, companies can add additional disclosures as long as the information is presented in a way that does not obscure the disclosures required by the ISSB standards. So these building blocks could involve disclosures that go beyond the investor-focused remit of the ISSB, such as information required by GRI for a multi-stakeholder audience, or to satisfy jurisdiction-specific information relevant to investors. So taking this global building block approach reduces the need to duplicate information by having a globally consistent baseline of disclosures, while still allowing you to report additional information based on standards like the GRI standards. Now, this objective, setting the global baseline, has had global backing. The baseline is reflected, of course, in the ISSB standards. They've been endorsed by the International Organization of Securities Commissions, who have asked their 130 members how they can incorporate the ISSB standards into their regulatory frameworks. There's support from the International Auditing and Assurance Standards Board and other audit and assurance standard providers, and you'll see the link there to ISSA 5000, which is the assurance standard for sustainability. The ISSB is working with jurisdictions around the world who are planning preparation for voluntary or mandatory adoption of the global standard. And of course, there's work to help market participants who are planning to support voluntary disclosure against the new standards, such as this training session today. So I'm going to hand over now to our colleague Vanessa from the IFRS Foundation, who's going to take us through more of the specifics of the standards.
Thank you, Louis. So it's my honor to be here today to share with you more about of our standards. So we have talked about the business case and the market case for the sustainability reporting, the evolution of the landscape and how it is being simplified and rationalized. So now let's introduce like IFRS S1 and S2. As we start, it's important to know that there are some key terms that should be understood. You can find the definitions in your handout, but I wanted to briefly mention them here. First of all, we will be saying the phrase sustainability-related financial information quite a lot. This can refer to a broad set of issues, including climate, nature, or biodiversity, human, social, and others. Sustainability-related financial information is information about a company's sustainability-related risks and opportunities that is useful to the investors in making decisions about providing resources to the company. The sustainability-related risks and opportunities are those that could reasonably be expected to affect the company's cash flows, access to finance, or cost of capital, such as whether it could affect the company's prospects. We will also often refer to a term called general purpose financial reports, which includes a company's financial statements and management commentary. You might know this as like a management report, a management review, or a strategic report. Some regulatories require specific disclosures in certain parts of general purpose financial reports. So we will use this generic phrase throughout our section. Moving on, anyone familiar with TCFD will recognize they will have like four core pillars or four content areas for the ISSB standards. Those are governance, strategy, risk management, and metrics and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of these today, and I encourage you to download the standards as part of your homework assignment. To all the preparers listening, let me start by saying, don't be afraid. Yes, there is a lot to understand, but you might be surprised that some of the detail is familiar. For all the accountants listening, you too will be relieved to see so many conceptual foundations developed by the IASB in the ISSB standards. So let's kick off the IFRS S1, or to give it the full title, General Requirements for Disclosure of Sustainability-Related Financial Information. If you are familiar with TCFD, you will see the same architecture applied throughout the standards. So our IFRS S1 as prepares to refer to and consider the applicability of the SASB standards and other sources of further guidance to identify sustainability-related risks and opportunities, and also identify material information. The SASB standards are organized by industry, enabling a company to identify in disclosure topics and metrics applicable to its business model and operations. So finally, the standards can be used to conjunction with any accounting requirements. And then moving on, let's talk about IFRS S2. So the scope of S1 is all sustainability topics except for climate. And the climate is covered by the S2. The second standard, what we call IFRS S2, focuses on climate disclosures. It is building on the same foundation of S1. For example, it fully incorporates the recommendations of TCFD. And secondly, it sets out the requirements for a company to disclose material information about its climate-related risk and opportunities. And thirdly, it requires the disclosure of both cross-industry and industry-specific information. And in terms of the climate-related risk, those include both physical and transition risk, which we will come back to them later. And there's other specific climate-related disclosures are required. For example, scenario analysis and greenhouse gas emissions. So for the purpose, you must also refer to and consider the applicability of the industry-based guidance on implementing IFRS S2. As we've said already, this is an organization by industry, enabling a company to identify climate-related disclosure topics and metrics applicable to its business model and operations. And S1 and S2, actually, they are not standalone standards. They are a package and must be complied together and applied together. Even when a company is reporting only on climate-related risk and opportunities, the companies must apply both IFRS S1 and IFRS S2. The reason behind is that IFRS S1 sets out general requirements or parameters for the type of information that needs to be provided in order to be decision useful for the investors. And also, IFRS S1 explains the concept of materiality and how companies identify material sustainability-related financial information. We will come back to it later as well. And now let's consider some of the conceptual foundations that underpin the ISSB standards, which might be new to anyone without an accounting background. So these concepts help us to understand how best to disclose information in order to meet the requirements of the ISSB standards. So to start with, the companies must fairly present a complete set of sustainability-related risks and opportunities. And also, fair presentation requires disclosure to be faithfully represented. To achieve this, companies shall provide a complete, neutral, and accurate description of sustainability-related risk and opportunities. The reporting entity concept requires the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. And also another important concept is connected information. We saw earlier when Fiona explained how different risks are often interconnected. The ISSB standards require companies to clearly identify key connections, such as those between risk and opportunities. Connections between the four pillars and the connection between the sustainability-related financial disclosures and the main financial statements. Now let me hand over to Louis for to share with us an example.
Thank you, Vanessa. And as this is the first example that we've come to in this training, I just want to remind everybody of the disclaimer that Fiona gave us earlier. We'll give you a number of examples in this training session today, but they are really for illustrative purposes, to illustrate things, to inspire you, to provide examples, but we're not suggesting that these are our best or even good practice. We're just sharing them with you to inspire you. So this first example is from a company called BHP, which is a global mining company. It's an extract from their 2024 annual report, the operating and financial review section. It's in this extract, BHP explains how it manages climate-related risk and plans to transition to a net zero economy. The extract illustrates connections between the company's decarbonisation strategy, its financial results and other processes. So it describes the impact of the company's climate-related risk assessment and climate scenario analysis on the business and capital allocation plans. So you can see that in the first paragraph, the company tells us that climate risk assessments and climate scenario analysis are integrated and connected into the company's strategy and actually treated as a sensitivity in their normal capital allocation process. So you can see their connections between the company's capital allocation plans and their climate-related risks, their scenario analysis, and their the external context, which is a rapidly decarbonizing global economy. Some assessments that they're undertaking are still in progress. So in the second paragraph, they tell us they're doing studies into the physical climate risks the companies might face. And they tell us that the results will be used to inform and therefore connect with the company's risk profile, corporate planning and controls and adaptation measures in future. So not only they're connecting things now, they're telling us how they're going to connect things when they have the results of their studies. Then finally, the light grey text at the bottom of the extract shows connections to further information on the impacts of climate-related risk on their operational activities, GHG emissions across the value chain, financial statements and production revenue and expenditure. So a good example of connection there. Over to you again, Vanessa.
Thank you. So after the example, let's have like a short test to like a quick quiz to test your understanding of the concept of connected information. So moving on, let's jump to the Zoom pool. So the question is asking what information should be considered for the connected information. So you have time to type in your answer. Yeah, we see more and more of like participants are answering, and we can now see the similar trends of selecting A, B, and C. Okay, for the benefit of time, so let me stop the Zoom poll here. Yes, we already have like around 65% of the people like participated Zoom poll. Yes, all the answers are correct. A, B, C are correct. So those should be considered for the connected information. And you will find more like you can find more explanation later on. So now let's moving on to talk about materialities. I can see there's like a question raising about how we can have like more information of materiality. So let's moving on. So let's briefly understand the definition of the materiality like defined in our standards. So the standards are built on the concept of materiality as defined by our IFRS foundation. We are going to go into this slide in more detail later, but just to highlight that we will be referring today to material information. So the definition is material information is information that, if omitted, misstated, or obscured, could reasonably be expected to affect investor decision making. So we will only talk about the investor as the main stakeholder we are talking about here. And moving on, during the ISSB consultation on the exposure drafts, one of the key feedback topics was the importance of supporting the preparers. particularly those with more limited resources and those in emerging markets. In addition to the standards and application guidance published in 2023, a number of educational resources were also published, and since then, others have followed, including the IFRS Knowledge Hub, and we are also in the process of gathering examples and case studies provided by our partners. So the SASB standards were aligned with IFRS S2 to help preparers seeking industry-based guidance, and the FSA credential was also updated with more planned to come. So I should also note that the IFRS Foundation Capacity Building Program, which is launched at the COP27, is a key part of our support to the preparers, and the SSE training initiative is one of our most important deliverables. Now let's take another Zoom poll to test your understanding of the materiality. So the answer is water is vital input into your business, but the ISSB standards do not currently have a specific standard on water. What do you do? You can, remember this is a single choice question. Just select the question you think is correct. Yeah, we can see like most people are choosing B. Yes, the correct answer, let me stop the poll here. So yes, the correct answer is B. It is suggested you can consult the sources of guidance listed by the ISSB. But I think actually C and D may also be useful, especially if you can engage like someone professional to assist your disclosure. I think it's also like a helpful choice. And also, I can see still like a few people choosing do not disclose anything about water. But as mentioned, water is important to your business. So it's following our definition of the materiality, you should actually disclose like information about water. Okay, so now let me hand over to Fiona for delivering the next topic.
Great, thanks so much, Vanessa. So that brings us now to the end of our first module. So we'll take a minute just to summarize and wrap up on the key themes we've covered so far before we do another quick Menti exercise. So just to review some of the key things we've talked about here. Firstly, we started with the purpose for sustainability related disclosures. And a key takeaway that we hope that you'll leave this workshop with is that there are important benefits both internally and externally for collecting and disclosing sustainability related financial information. And ultimately, if you're not making good use of that data that you're collecting to improve your own decision making and efficiency operationally, you're going about this wrong and you're wasting an opportunity. And also, if you have operations in perhaps difficult to abate or high impact sectors, your competitors could well already be disclosing these risks and identifying opportunities that they're pursuing. And ultimately, that's going to then leave your investors wondering why you're lagging behind them. And that might start to affect your ability to raise funds as well. And next, we looked at the evolution of disclosure standards, the formation of the ISSB, and that aim to simplify the reporting landscape. And when you're thinking about other voluntary disclosures, you shouldn't see those as competing with the ISSB standards, but rather building on top of them. And then finally, we introduced the standards and the important concepts that you need to understand in order to use them correctly. And a key point I want to reiterate here from what Vanessa just covered with us is that the standards and the guidance that come with them are designed to meet the needs of investors. And so they're heavily focused on those prospects that we discussed at the start of the unit around effects on financial performance and position. Okay, so that moves us in, as I said, to our wrap-up exercise from this module. So for each module, we like to finish with an exercise, and these exercises are also connected to the work in the homework handout as well, which you can use to build out your responses on these sections further. And they're also designed to help you thinking about the elements of that disclosure plan that we'd recommend that you create. So our first exercise really is to reflect on how you can define objectives for your sustainability disclosures. So I know many of you mentioned at the start that maybe regulatory compliance was your top objective, but of course we really recommend you to take a holistic approach here and to think about the different things that you can achieve through sustainability reporting. We think it can be helpful to have documented that objective and make sure you're clear with your internal colleagues and your leadership on what you're aiming to achieve through your sustainability disclosures. So here you want to be thinking about what the goals are that you're trying to achieve, maybe defining in particular what reporting requirements you're seeking to meet, and overall considering the degree of change that you think you need to make. So maybe if you already have quite advanced reporting, you have smaller amount of changes to make just to align to the new reporting framework. But maybe if you're starting at an earlier point in this, you need to be a little bit more ambitious with your goal here because you have quite a lot to achieve. So let's take a look together in Menti at what you think about this question. So the question, as I said, is what are your objectives to achieve through sustainability disclosure? So taking a moment just to reflect on that point. So I've shared the Menti link again, and I'll just share my screen so that that gives you the other options to join us and so that we can see your responses. Brilliant. Thanks everyone who's already shared with us there. Great to see lots of ideas coming through already. So let's see what kinds of things you're setting or thinking about as your objectives. So someone at the top here has mentioned around financial investors and stakeholder interests and thinking about those risks and opportunities. Indeed, I think that's a great point to highlight. Of course, disclosure for regulatory purposes is one thing, but of course the purpose here is to give your investors and other stakeholders relevant information on those risks and opportunities. So great to keep that audience in mind. Someone's mentioned here about creating long-term value as well. That's a great objective to bring into this. And another person's mentioned that too on the right-hand side, that they want to balance complying with the Bursa's listing requirements with also ensuring that the company gains value from the information that's being prepared. So I think that's a great way to balance and think about both sides of things. Someone's mentioned about holding ourselves as a responsible business. So that's great to highlight too, you know, thinking really about your own organization's values here. Enhancing transparency and building stakeholder trust, meeting regulatory expectations, thinking about how to manage impacts and long-term value creation. So that organization sounds like they want to take quite a holistic approach here to thinking about all of those different facets. So a few more people mentioning kind of compliance with the Bursa's requirements. And of course, there's no problem there in making sure that regulatory compliance is the top priority. Of course, that's sort of the basic foundation that we need here before perhaps we might be able to move on to more advanced objectives. But wherever we can, I think trying to set out from the start to do more than comply, I think can make sure that we build the right processes from the outset that can help us to get the real benefits from this process. I've seen some similar responses here. So I'm seeing mentions of responsible business and building stakeholder trust as well. Some people are mentioning the potential to attract different kinds of investors and to attract new capital. So indeed, I think that's very likely something that could be explored further. So a great point to highlight, I think, to your colleagues that that is a possibility from this process. Brilliant. And someone's mentioned also around risk management and operation efficiency. So I think good ways to think about how to use this information internally indeed. So it might be that the process to identify those risks and opportunities can help you to kind of tangibly implement things that can improve efficiency, reduce costs, etc., like that as well. Great. So climate and social responsibility being mentioned here, and maybe thinking about an inclusive work environment too. True and meaningful data and insight to the business and investors, that the company and customers as well. So yeah, that's another stakeholder group that's important to highlight. So whilst you might be starting out with collecting this information for investors, if it's information that can support your customers, maybe in meeting their expectations of you as a business from a sustainability perspective, or contributing to their reporting too, that can be a very helpful thing to highlight. Great. Boosting investor confidence. Yeah, and maybe someone here is mentioning the sequencing. So maybe, as you say, first off, you need to comply. Secondly, it's about competition and then building towards resilience. So yes, absolutely, you might have a process that sort of iterates and gets more ambitious over time once you've got the compliance side of things squarely established. Fantastic, lots of great responses here. Thank you everyone for taking part in this. It's always great when we have lots of responses to talk about together. And hopefully a way to also get some inspiration from each other as well and see what others are thinking about on this. So I think there's lots of common themes here, but also every organization's approach a little unique as well. So it is great, I think, to do as you're doing and reflect on your organization's own particular objectives from this. I'll just have a little look and see if anything's jumping out to me that is new or different that we didn't already talk about, but I think I'm seeing similar themes perhaps coming up here. Brilliant. Thanks, everyone. The responses just keep going, though, so that's great to have so many of them in. So I think you can also scroll through those further in Menti if you'd like to do so. So I think really you probably highlighted everything that we would have recommended for this point of the exercise. But I think one thing we'd really encourage, as you have already done so, is to make sure you're thinking about that audience and maybe thinking about any feedback that you already have from your stakeholders as well. So maybe you have some insights coming into your investor relations team about the types of questions that you get from your investors, the types of issues that are front of mind for them relating to your company or your sector. So being sure to use any existing investor feedback that you have to help you target what you identify as material and what you build into your disclosure practices can be helpful. And also looking to the future as well. So, of course, it's good to comply with what we see directly in front of us at the moment. But as much as we can horizon scan and think about how things may evolve in the future and be adaptable to that, I think can be helpful to build into your thinking at outset too. Brilliant. Thanks so much for sharing that, everyone. So I will close down the Menti now and we'll go back into the slides, and then Vanessa's going to get us started on module 2.
Okay. Thank you. So I'm sure that like all of you have like a basic understanding of the concepts we have talked and discussed like previously. And now let's dive into how to apply the ISSB standards. I can see some questions raising how, and we will explain them and taking into account additional disclosures, including any relevant geographical or sectoral requirements, as well as peer practices and your leadership's objectives. In order to understand how to ensure your disclosures meet the global standards, we will look at two key concepts in this unit. First one, and the main focus of this unit is it will be on how to apply the standards to achieve a global baseline for the disclosure. Sorry, it should be here. Yes, and once we cover that, we will also discuss how additional disclosures fit. To begin with, let's focus on how to apply the ISSB standards as the global baseline. Let's get started on the first pillar as we talk about governance. This includes the aspects that relates to the governance body in your company and how management is applied. For each of the 4 pillars, we will discuss questions that you could ask in your company to start identifying the information that will support some of the disclosure requirements, for example, as part of a gap analysis. So if we look at the governance and management requirements, we can see that there are several that are fairly qualitative. For example, we have like some frequent questions such as which bodies are responsible for the oversight and management of the process, controls, and procedures of sustainability-related risk and opportunities. Also, for example, is the management responsibility delegated to a specific role or a committee, or whether your company has a specific sustainability committee? And the second question is that how and when do they get informed about sustainability-related risk and opportunities? And the third question, maybe how these issues inform strategy, decision-making, and risk management. This This could include setting targets to manage sustainability-related risk and opportunities. And last question, whether the progress against these targets linked to the management KPI. So for more information, you can make use of the UNSSE checklist too. But remember, it's not a replacement for reading and using the full ISSB standards. And now let's take a look at a couple of examples and what we mean in practice. So let me invite Louis to share the examples.
Yes, thank you, Vanessa. The first example we're going to look at is from a company called Yara, and Yara is a global crop nutrition company, huge, 17,000 employees in 60 countries. In this governance model, from their sustainability statements within the 2024 integrated report, we see that Yara has a highly integrated model with responsibilities for sustainability embedded across many relevant business functions. These are set out in the middle of the screen in the pale green boxes. So there's responsibility within HR, ethics and compliance, global climate and energy, corporate affairs, innovation, health and safety, and so on and so on. In terms of the governance structure, the Board Audit and Sustainability Committee we see at the top of the screen assists the Board of Directors in overseeing the process for and internal control of sustainability reporting and material sustainability risks and opportunities and impacts. Then the sustainability governance team we see in the middle row have a direct reporting line to the chief financial officer, and they're responsible for sustainability performance and reporting, and their work is closely aligned with the corporate performance and risk functions. The sustainability network we see at the bottom of the screen reviews Yara's accountability processes and systems that they have in place for ESG policies, and they monitor sustainability performance. Now, that network is chaired by the Chief Compliance Officer. We can see arrows on this screen, and they're used to indicate the flow of information and monitoring and oversight between the different governance bodies in the organisation. Of course, there's not the IFRS S1 and S2 don't set out how governance is to be structured. There are many models to choose from. So each organisation has to choose the structure that's right for them and that fulfills their particular needs. This is just one example of a highly integrated model. Let's look at another example, and this is from Toyota, who I'm sure you all know is a car manufacturer. It's an extract from their 2024 report and explains the role of the Sustainability Committee within the company's governance structure. It's one of the business execution committees that reports to the President and Board of Directors. So we can see the frequency with which they meet. We can see who chairs the committee, and in this case, it's the executive in charge of enterprise risk and compliance management. And the extract shows who the members are. And again, like the Yara example, we can see that they come from a wide range of disciplines within the organisation, from administration, accounting, technical executives, and so on. And finally, we see what the committee's agenda is and what actions they've taken in the year. So their job is to approve action plans on sustainability, including targets, and evaluate activity results. They determine the direction of the company's approach to sustainability, ensure that it captures the opinions of stakeholders and social trends, and they revise the sustainability policy, and there's a link to that policy within the report itself. So with those two governance examples, we're going to hand over to Fiona to take us through the strategy pillar.
Thanks, Lois. So great. Now with those examples, hopefully making governance fairly clear, we'll look at the next core content area here, which is strategy. So strategy has quite a few more disclosures to include than governance, but it's also really where companies can start to see the benefits from sustainability related opportunities and being better prepared for those risks. So as you can see here, there are 3 high-level areas that we focus on in the strategy core content area. And those are risks and opportunities, effects, and resilience. So we'll take a moment to review each of those separately now. So starting out with this section and some of the key questions to evaluate. So IFRS S1 and S2 disclosure requirements on strategy are really designed to enable the users of your reports to understand the company's strategy for managing sustainability-related risks and opportunities. So this is all around disclosing what are those particular risks and opportunities that you've identified that you expect could affect the company's prospects. And then over what time horizons are you expecting those effects to occur? And this is where we also need to keep in mind that financial effects could occur before the risk or opportunity materializes, or maybe afterwards, and they can change over time, connecting back to that piece I covered at the start about the time horizons for sustainability risks. And then the last item on the list here is really looking in particular at climate-related risks. And so this is aligning with the requirements from S2. And so this is where investors will also want to understand the different types of risks and opportunity that companies have considered. And so we often see companies here using the categories that were developed by the TCFD of physical or transition risk. And both S1 and S2 will include guidance to support companies in identifying and disclosing risks and opportunities. And they also recommend the use of further industry-based guidance here and the SASB standards as well. And so let's have another look at an example here to see what this could look like in practice. So this example comes from Mondi Group's 2024 integrated report. And Mondi is a multinational packaging and paper company, and they operate across Europe, North America, and Africa. And in the left-hand side of this extract, we see which risks the company has identified, how those risks align with 4 different key categories of strategic, financial, operational, and compliance, and then the delegated risk owners as well. And so there's a lot more information about these risks in their report, but the climate change risks are one of the areas that they've identified there in their principal risks. And so in the right-hand side of the screen, we then see a further breakdown of those climate risks and opportunities, categorizing them into physical and transition risks and opportunities as well. And so that's useful to see the summary that Mondi have provided of those different risk types. And alongside this, they provide commentary to explain how they've identified them and what they expect the particular effects to be of those risks. And you'll also see for the climate risks, they've then drawn out the time frames of short, medium, and long term over which they expect the effects of those risks to occur. And maybe one interesting element to this disclosure is that they highlight maybe when they expect the effect to start, but also when they expect it to be felt at the fullest as well on that scale. So that's perhaps a useful indicator to include. And so another aspect of the risks and opportunities identification that will need to be disclosed brings us back to what we talked about at the beginning of time. And so you might remember when we talked about it earlier that time can be something that's quite different when we're talking about sustainability risks and opportunities. So let's be really clear what we mean by time horizons. So the standards ask you here to identify within what time horizons any material effects are expected to occur. And how you define short, medium, and long term will vary between companies and depend on a number of factors. And so, for example, some of the factors that you might want to consider to define your time horizons would include your investment and business planning cycles, the strategic planning horizons of your organization, perhaps the lifespan of any assets that you operate or own, and also the assessment periods used by your investors. And so what's important to remember here is that you do need to define that time horizon. So don't expect your investors will necessarily know what you mean by short or long term unless you give them a clear quantitative definition of what you're using. And then moving on to the second group of disclosures in strategy category. So that first area there was all around identifying the risks and opportunities. And now we're moving on to thinking about what exactly the effects of those risks and opportunities are and where they will occur in the business. And so to start tackling the disclosure requirements of the standard here, companies will want to start asking themselves questions such as describing what the effects are, and understanding what the immediate response plans they have for mitigating or adapting to those risks and opportunities. So that might be responses that you have already implemented, or maybe it could also be things that you could plan to implement in the future as well. So let's share again another example here. And so this example comes from BASF, which is a global chemical company. And in this example, BASF are illustrating really how the effects of sustainability risks and opportunities impact different aspects of their business model and value chain. So it's always hard to do justice to a report on a single slide. So we've picked here just a visual summary, but really it's the narrative that sits alongside this that's useful as well. But what they illustrate here is how they expect sustainability risks and opportunities to impact them across these different areas. So in the upstream, they're thinking a lot about how they engage with their supply chain, so how they can source more bio-based and recycled raw materials as inputs to their process, and also source renewable energy. Within their own operations, they're thinking a lot about the efficiency of their chemical production processes. And so thinking about how they can use different feeding processes, how they can use energy more efficiently as well, and use smarter technologies in their processes. And finally, in the downstream, they're thinking more about how they can target selling products to their customers that particularly are sustainability related, and how they can kind of respond to that customer demand they're seeing. And in the commentary that sits alongside this visual, they talk about the target that they have set themselves to achieve more sales revenue from products that contribute to a circular economy. And so this really illustrates how the different sustainability impacts they've identified are being incorporated into their business strategy, and that they're making connections then between those risks and opportunities, the targets that they set themselves, and the investments they're making in technology to achieve that. And so one of the obstacles we know that companies can face when they're reporting on the effects of risks and opportunities is what kind of detail needs to be disclosed. And in that example that I just shared with you there from BASF, we were mostly seeing qualitative disclosures and descriptions. But what about quantitative information? So under the standards, a company is required to disclose both quantitative and qualitative information about the current and anticipated financial effects of sustainability risks and opportunities. However, the standards do also set criteria for when only qualitative information is required. So using only qualitative information can be permitted for a number of reasons. So if a company cannot separate the effects of a climate or sustainability risk from other effects, that's one possibility. Also, if there is a high level of measurement uncertainty, or finally, as well, if the company doesn't yet have the skills, capabilities, or resources to provide that quantitative information. So as I've said, the aim is to provide quantitative disclosures, but there are a number of reliefs here that would allow a mix of qualitative and quantitative information, or just qualitative information if necessary as well. So that now brings us to the last part of the strategy component. So firstly, we looked at the identification of risks and opportunities, then at what the effects of them are. And now this group of disclosures is looking particularly at how companies can prepare for those uncertainties and ensure their resilience into the future. And so this really gets into the practices and processes that companies have in place to assess their strategic resilience and make adjustments where they need to. And the disclosure requirements here will include information on the types of assessment that have been used and how scenario analysis has been employed to make that judgment on capacity to adjust. And so the kind of key requirement behind scenario analysis disclosure is that there's clarity provided on the different inputs and assumptions that have been used in scenario analysis. So again, let's look at a few examples to help us see what this could look like. So our first example here is from Stora Enso, which is a Finnish and Swedish forest products company. And here we're showing really how they've kind of integrated the sustainability issues into their strategy. And actually what Stora Enso identify is that their core sort of business as usual activities, which relate to forest products, paper and pulp, etc., are likely to decline over the medium to longer term. So they're going to see a potential reduction in their revenues from what is today a key part of their business. And so what they've then set out in their reporting is a clarity over what the resilience measures are that they're taking to adjust to that trend. So for example, they've identified new growth areas for their organization relating to sustainable buildings solutions, renewable packaging, and biomaterials innovation. So they show us that mix of those different activities in the top part of the visual. And in the bottom part, they show us as well how they're expecting the revenue mix for their business to change over time. So by 2030, they actually expect that 80% of their sales will be coming from these potential future growth areas. So within the narrative alongside this, they then explain some of the actions they're taking to respond to this and ensure their resilience for the future. So for example, investing now in the technology required, converting their current machinery, for example, to work with renewable packaging materials. And our second example here is from Solvay, which is a Belgian chemicals company. And we're using this example to show particularly how they've reported on the financial effects of the risks and opportunities and how they've disclosed the scenario analysis processes that they've employed. So in the top part of the disclosure, we see a summary of how they've reported their scenario analysis. So here they provide good transparency about the estimates they've used, and they talk about the different tools they've used to conduct their scenario analysis, the timeframes over which it was conducted, and the different climate scenarios they've employed and the sources of those scenarios. And then in the second part of the disclosure, this is where they've reported on the financial impacts of different risks and opportunities. So they've used a kind of qualitative scoring range to show the magnitude and direction of potential financial effect from a -3 to a +3. So we do see there that they've provided some balance and transparency between providing both information about opportunities and potential risks as well. Okay, fantastic. So to round off this section, we'll just have a quick poll just to test your understanding on one of the concepts that I just covered there. So the question here is that a company can choose to disclose only qualitative information or a combination of qualitative and quantitative information about financial effects when. And here you need to select which of these criteria you think I mentioned were possible reasons for allowing qualitative disclosure. So either if the company can't separate the effects of a climate risk or opportunity from other effects, if there's a high level of measurement uncertainty, or if the quantitative information sheds a negative light on the company. So I'll just give you a few more seconds to have a think about that before we share the right answers. See lots of responses coming in already though, so thanks again, everyone. Okay, maybe just 3 or 4 more seconds. And then I think I'll end the poll now since I can see a fairly clear pattern of pictures, of answers. And there's the results for you. So most people indeed were correct here. The top 2 options are both acceptable reasons for disclosing qualitative information. But as most of you correctly identified, the bottom option is not an acceptable option. So of course, it's important that we provide transparency and balance in our reporting. So if we do have information about potential negative impacts that we can report to our investors, if that's material, of course, it's important that we do disclose that information. Okay, thanks everyone for sharing. So I'll just close that down and I'll pass over to Lois now, who will get us going into the next segment.
No. So when we looked earlier at governance, didn't we, for example, and with governance, there are no specific climate-related considerations for disclosure, but with strategy, which is the longest set of requirements in IFRS S2, there are some additional requirements that apply specifically to climate in IFRS S2, and we're going to look at those now. Now, the title of this slide, From TCFD to Strategy, is for those of you that already know the TCFD recommendations. So you can see how the S2 requirements are broadly consistent, but there are some differences as we discussed earlier. But for those not familiar with TCFD, this list is helpful about the what S2 requires. So first of all, S2 requires a company to refer to and consider the applicability of industry-based disclosure topics, and these are set out in the industry-based guidance for identifying climate-related risks and opportunities, and that's available on the ISSB website, and it's based on the SASB standards. So bear in mind a company is required to consider the applicability of those topics, and the topics have metrics associated with them too. Secondly, S2 requires a disclosure of detailed information about where in the company's business model and value chain risks are concentrated. So there might be some physical assets that are particularly prone to physical risks from climate change, for example. Thirdly, S2 requires details of how a company responds to or plans to respond to the effect of the climate-related risks and opportunities it's identified. So one possible response to those effects could be to set climate-related targets and how the company plans to achieve them, and maybe they in turn are set out in a climate transition plan, and we're going to look at those in a moment. In providing disclosures about the current and anticipated effects of the risks and opportunities on a company's financial position, performance, and cash flow, S2 sets out criteria for when quantitative and qualitative information is required. Now, qualitative information only is permitted in some circumstances. For example, when a company can't separately identify the effect of a climate-related risk or opportunity from other risks and opportunities, or when the level of measurement uncertainty involved is so high as to make any quantitative disclosures not useful. Then when it comes to preparing disclosures on anticipated financial effects, S2 requires a company to use all reasonable and supportable information available to it at the reporting date without undue cost or effort, using an approach that's commensurate with the company's requirements. And of course, this recognizes that it can be very tricky to identify anticipated financial effects. Then on the penultimate bullet point there, bear in mind that S2 requires a company to use climate scenario analysis for assessing its resilience, but it does not specify the scenarios that a company must use. And that's because it would depend so much on the company's own circumstances, what they do, where they're located, and what their strategy is. And finally, S2 requires information about the company's resilience analysis, including any significant areas of uncertainty. It's considered whether and to what extent the company has the capacity to adjust and adapt its strategy and business model over time, and of course details about which scenarios were used and when and how they were carried out. Now, I mentioned earlier that one of the responses to the identification of climate-related risks and opportunities might be to develop a transition plan. So S2 requires a company to disclose any climate-related transition plans they may have. So bear in mind, S2 doesn't say you must have a transition plan, but it says if you do, you have to disclose details about it. So let's look first of all at how transition plan is defined in S2. It's defined as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy, including, for example, GHG emissions reductions plans. So as a transition plan is an aspect of the company's overall strategy, it must, of course, align with that strategy, the business case, business motivation for it, and align with the decarbonisation levers that are most economically and technically feasible for the company. Secondly, the transition plan should be aligned with science, including what science says about requirements for net zero to be achieved, how carbon neutrality or Paris-aligned goals are to be met or explained in terms of science. Thirdly, the transition plan must, of course, set long-term goals, and these must be supported by activities and targets to achieve those goals and interim milestones and targets against which progress can be monitored. Of course, the transition is uncertain. Nobody knows exactly how it will unfold. So the plan should be transparent about any uncertainties, dependencies for its progress and success and execution, and set out the risks and challenges of implementing the plan, including how any residual or unabated GHG emissions will be treated. Because the transition will proceed in different ways for different sectors, sector-specific pathways can be reviewed to inform the development of the company's transition plan, and we'll look at some resources for that in a moment. And finally, companies should consider how their transition plan will be evaluated and give it the hallmarks of credibility that are set out in some resources we're going to tell you about right now. So let's look at the resources. Now, we can't, there are loads and loads of resources, and we can't share them all with you here, of course, but the triangle on the left-hand side of the screen is designed to show you that those developing resources are all designed to support each other. So the work of the Glasgow Financial Alliance for Net Zero, or GFANZ, builds on and supports the work of the IFRS Foundation, as does the work of the Transition Plan Task Force. And as we heard earlier, the IFRS Foundation has assumed responsibility for those disclosure materials of the TPT. In terms of the specific guidance, first you will see an IFRS guidance document disclosing information about an entity's climate-related transition plan in accordance with IFRS S2. That's a very comprehensive guidance there, quite new as well, and it has some great guidance for you. Now, the UN Sustainable Stock Exchange, we've also issued model guidance on climate transition plans. And this doesn't just cover disclosure, it's also got some more practical advice in it, and also draws significantly on the work of the Transition Plan Task Force. So you can find that on our website, and Fiona's kindly given the link to it in the chat. But one thing you'll find in there, amongst others, is a list of the hallmarks of a credible climate transition plan, which I mentioned just earlier. We said, didn't we, that it's useful to look at sector pathways, and indeed GFANZ is one of the organisations that present sector pathways for financial institutions and expectations for real economy companies. And of course, the TPT work and disclosure framework and other materials are still available via the ISSB website. So lots of resources to help if you have a transition plan or want to develop one. Now, you'll be pleased to hear that we're going to take a short 5-minute break. So do take the opportunity to have a stretch, get a drink, and feel free to keep asking us the great questions that you're sending us in the Q&A box. We'll leave you with some relaxing music, and I'll see you back here in 5 minutes. everyone, and welcome back. Hope you had an opportunity for a stretch and a drink and a think. We know this is a lot to cover in 3 hours, but let's go on to the next core content area, which is risk management. And this core content area is about the process that companies use for risk management and whether and to what extent that process is embedded within the company's overall risk management approach. So the sorts of questions that you might want to ask within your company to answer these requirements are: what policies and processes are used to identify, assess, prioritize, and monitor sustainability related risks and opportunities? And how are those processes integrated into the company's overall risk management process? Now, somebody asked the question earlier, do we have to have an enterprise risk management system? Well, certainly the IFRS standards don't say you must. There might be other laws or requirements that apply to you that mean that you do have to have one, but if you have one, then the IFRS standards ask you to disclose details about it. So you'll be looking at things like what do those processes tell us about the inputs and parameters used for risk management, the way in which sustainability related risks and opportunities are prioritized, and over what time frames. As Fiona told us earlier, you know, the time frames could be much longer than for other risks when we're looking at sustainability risk. These processes might look at how the nature, likelihood, and magnitude of risks and opportunities are assessed and monitored, and also whether and how processes change over time. So in relation to climate-specific considerations on risk management, there are certain specific things to bear in mind, and we'll look at those now. Again, as we know, ISSB standards build on TCFD recommendations and they're broadly consistent, but S2 requires detailed information about the input parameters used to identify and assess risks, including whether scenario analysis has been used to inform risk identification. As you know, it's really for resilience analysis, but can inform risk identification, and we're going to look at an example of that in a moment. But also whether and how the risk management processes have changed. You'll need to disclose that in response to S2. The same considerations apply when looking at climate-related opportunities. Now, in terms of climate-related risk, we actually have a definition of climate-related risks in S2. And these come from the TCFD recommendations. So the two main types of risk, transition and physical. Transition risks arise from efforts to transition to a lower carbon economy, and they're often categorized as policy and legal, technological, market, and reputational risk. And you can see some examples of those in the middle column there. So transition risks are things like increased pricing of GHG emissions, enhanced reporting obligations like we're talking about today, exposure to litigation, costs associated with the transition to lower emission technologies, the implications of changing customer behavior and consumer preferences, uncertain market signals, increased cost or availability or quality of raw materials, and so on and so forth. These are all examples of transition risk. There are two types of physical risk identified in the standards: acute physical risks that are event-driven, and chronic physical risks that arise from longer-term shifts in climatic patterns. So chronic physical risks could include things like changes in rainfall and temperature, sea level rise, reduced water availability or quality, changes in biodiversity, particular biodiversity loss, and changes in soil productivity. And acute risks arise from weather-related events such as storms, floods, droughts, and heat waves, and we can see that these are increasing in severity and frequency. Now, in both cases, these risks can give rise to financial implications for a company, all sorts of financial implications, such as the costs resulting from direct damage to assets from acute weather events, or indirect effects of supply chain disruption, or changes in financial performance because it's been affected by shifting consumer demands, or costs of developing new technologies, or changes in resource availability, all sorts of things that can give rise to effects that reflect in cash flows, access to finance, cost of capital, and of course these effects are felt over different time horizons. Similarly, in the standard S2, we have a definition of climate-related opportunities, and these opportunities can come from becoming more resource efficient across the whole of the value chain, changing to lower emission sources of energy, developing new products and services to respond to the low carbon economy transitions or consumer demand, developing into and accessing new markets, new products. Differentiating yourself against competitors is a great opportunity, and being able to bolster your resilience, perhaps by all of these things, and using resource substitution or diversification. And similarly, of course, these give rise to financial effects over different time horizons. We'll have a look at an example now. This is an example from the RS Group, from their 2024 annual report. The RS Group is a UK-based distributor of electrical and industrial equipment. They've got global operations. This group has analysed their climate-related risks and opportunities for a number of years, and in their annual report elsewhere, not in this extract, they identify 10 principal risks, one of which is climate-related transition and physical risks to their business. And this extract describes some of the physical risks. Their most significant physical climate risks relate to the impact of extreme heat, you can see that on the first line there, on their distribution centres and sites, and the potential for extreme weather events to cause physical damage and disruption to their supply chains and distribution sites. We can see that on that risk on the second last line there. Now on each line we also see this little red wheel icon, and this shows us that strategically the risks affect operational excellence, but we also see from the icons below the wheel which stakeholders are most affected by the risk. So we get also here a description of the risk. We get information about the business owner who is responsible for the risk. We see which metrics are utilised to monitor the emergence and management of the risk. And in the final column there, we see their activities in the reporting year that are taken to manage risk or opportunity, and also to manage it over time, such as what capital investment might be needed to protect the company, and also what their future focus is for the upcoming year to manage the risks. So let's hand over to Vanessa now for the next core content area.
Okay, thank you, Louis. So let's moving on to the last core content area, metrics and targets. We will now spend some time reviewing the disclosure requirements on the metrics and targets in more detail, which is, as we discussed, is the final pier of our standards. So let's kick off with metrics first. The requirements on metrics are designed to enable investors to understand a company's performance in relation to its sustainability-related risk and opportunities. Preparers shall disclose information, explain how the metrics are defined, if they are absolute or relevant or relative, if they have been validated by the third party, as well as the methodology, such as what is the method of calculation, what were the inputs, are there any limitations, and what assumptions are involved. And now let's move on to the second part of this pillar, targets. The requirements on the targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its strategic goals. So the disclosures should include, firstly, whether they are qualitative or quantitative, and whether it is set voluntarily or by law or regulation. And secondly, the metric used to set the target and to monitor progress towards its achievement. And thirdly, the baseline period from which progress is measured and the period to which the target applies. And fourthly, what are the milestones or interim targets? And lastly, if there have been any revisions to the targets together with an explanation about the revisions. And now let me hand over to Louis again for the example.
Thank you, Vanessa. So this is an example from a company called CLP. It's one of the largest investor-owned power businesses in Asia Pacific, and it aims to be a leading responsible power provider. Now, you've probably noticed in many of the examples we've seen in this training session, they've been about climate change. But this extract from CLP it shows its disclosures about waste management and material use, and in particular the metrics it uses to monitor its waste management and material use. And bear in mind that sustainability related risks and opportunities apply across many different sustainability topics. So the first thing to notice is that in the right-hand panel, we see that CLP has set group-wide medium and long-term waste targets for the years 2025 and 2030 in terms of the amount by which they want to reduce the total waste produced. And also they've got, this is part of a wider strategy for the circular economy. And we see in the first panel that they continue to promote implementation of circular economy concepts. So there's a strategic connection to these metrics and targets. In the bottom panel, which I won't go through, you can see the report on the results against the targets that they've set and the results as they apply as at 2024 by reference to the 2025 and 2030 targets. And you can see as at 2024, they're mostly in line with their expectations. Now, the other thing to notice here is that we know that at the moment the ISSB doesn't have a standard on waste management and material use, but note this little pale grey text in the first panel, SASB reference and GRI reference, and this tells us that the metrics here have been calculated in line with SASB and GRI framework. So we might come back to this later, but you've got here an example of metrics and targets. They're linked to strategy and circular economy concepts from CLP. Oh, back to you now, Vanessa.
Thank you. And now let's talk a bit more about like the metrics and targets related to the climate specific considerations for the disclosures. So let's like talk a bit more about it. So the TCFD framework included the recommended disclosures, which IFRS S2 builds on and S2 as part of the required disclosures. For example, the IFRS S2 requires disclosure of industry-based metrics relevant to a company's business model and activities. And secondly, additional disclosures are required to GHG emissions, including separate disclosure for the consolidated accounting group and associated joint ventures, and information about the company's financed emissions. In addition, IFRS S2 sets out a Scope 3 measurement framework to provide guidance for preparing Scope 3 GHG emissions disclosures. While IFRS S2 does not explicitly require a company to disaggregate its GHG emissions disclosures by the constituent gases, IFRS S1 includes requirements on disaggregation that would result in the disclosure of the constituent gases being required if such disaggregation provides material information. So I would like to remind everyone that you can access more information on the climate metrics in the SSE's training tool on this topic. And also we will share this link in the chats, and you can also find it on the SSE's website. So likewise, there are some additional disclosures compared to TCFD for the targets as well. So for example, IFRS S2 requires disclosure about how the latest international agreement on climate change has informed the targets and whether the target has been validated by a third party. And also, IFRS S2 requires disclosure of more detailed information on greenhouse gas emission targets, including additional information about any planned use of carbon credits to achieve a company's net greenhouse gas emission targets. And also, IFRS S2 includes additional requirements to disclose information about the approach to setting and reviewing each target, and how it monitors progress against each target, including whether the target was derived using a sectoral decarbonization approach. We have talked a lot about like greenhouse gas emission metrics. I assume maybe some of you don't have like too much knowledge about it. So let's briefly explain the greenhouse gas emission metrics here. So when we talk about the greenhouse gas emissions, you need to familiar there are actually different scopes. Scope 1, Scope 2, and Scope 3. So Scope 1 includes all direct emissions that occur from sources owned or controlled by the company, such as emissions from your company's facilities or vehicles. And Scope 2 includes emission from generation of acquired or consume electricity, steam, heat, and cooling, such as the electricity you purchase. And Scope 3 is then all other indirect emissions that occur in the company's value chain. And also IFRS S2 requires a company to disclose its absolute gross Scope 1, Scope 2, and Scope 3 GHG emissions in accordance with the Greenhouse Gas Protocol's corporate standard. So unless a jurisdiction requires a company to use a different approach to measure, so it's suggested you need to disclose your Scope 1 and 2 and 3 emissions in accordance to Greenhouse Gas Protocol corporate standard. If a company is using a different measurement method, there is a transition relief to use the method in its first year of applying the standard. And also whether and how the company is using an internal price on carbon for decision making, and whether and how executive KPI is linked to climate change. So actually on May 29th this year, IFRS Foundation has published a new educational material. I think I'm soon colleague has presented in the Q&A format. Presented in a Q&A format, detailing the greenhouse gas emissions disclosure requirements under IFRS S2, including measurements, the use of the greenhouse gas protocol, and how to report Scope 1 and 2 and 3 emissions in line with the standard. So if you have any questions about how you can actually take a reference on how to report and how to use the greenhouse gas protocol to disclose your Scope 1, 2, and 3 emissions, I would suggest that you can take a further look at our educational material. And now let me hand over to Louis for the example.
Thanks, Vanessa, and thank you for mentioning the educational material. And everybody, please bear in mind that this example was produced before the educational material came out. But what is a good example of is showing how a company breaks down their GHG emissions. And the company in question is Enel, which is an Italian producer and distributor of electricity and gas. This is an extract from their 2024 GHG inventory. So they produce a separate document, an inventory that gives really comprehensive information about their greenhouse gas emissions, including their strategy and ambition to achieve net zero emissions by 2040, and of course to promote energy generation from renewable sources. So at the top of the slide, you see the company's carbon footprint broken down by scopes 1, 2, and 3 greenhouse gas emissions. So you can see that there are shaded bars, blue shaded graph bars and dark blue graph bars. And this is because in each case, scope 1, 2, and 3, and overall, and scope 1, 2, and 3, the 2022 base year emissions are compared with the 2024 emissions for the reporting year. So you can immediately see a number of things. One, trends. You can see that the trend from 2022 to 2024 is one of declining GHG emissions. Two, you can see where the majority of greenhouse gas emissions arise from scope 3 and from scope 1. So there are lots of other breakdowns within the inventory, and we've just given you an extract at the bottom of the slide, which shows a breakdown of some of the scope 2 emissions. So they give the breakdown by business activity in the first column, the activity being power generation and others. They give us the breakdown by source, from electricity consumption from the grid in power plants in the first line, and from electricity consumption from the grid in terminal ports in certain locations in the second line. Again, they're giving us the comparison between 2022 and 2024, so you can see the extent of the reduction in each of these sources. And finally, they give us the breakdown across calculation methods, and these are the location-based method and market-based method. These calculation methods only apply to scope 2 emissions. The market-based method reflects emissions from electricity the company purchases based on the contracts they enter into, and the location-based method reflects average emissions intensity of the local electricity grids to which the company is connected and which are tied to their electricity consumption. There are lots more breakdowns in the report. So let's go on to have a Zoom poll. And the poll asks, what is the objective of metrics? In particular, what's the objective of the metrics disclosure requirements in S1 and S2? Is it, you can select all that apply, to enable report users to understand performance in relation to the company's sustainability-related risks and opportunities, to understand progress against any targets, or to understand the company's assumptions for the future? Give you a minute to think about that. Lovely. You can see a clear pattern now. So let's share the results. The majority of you answered A and B, and the majority of you are correct. Excellent audience here today. Now, those of you that answered, well, the objective of metrics is to understand the company's assumptions for the future, that's probably true, but the reason we've asked you the question in this way is to encourage you to read the standards themselves. They're actually quite short, but each of the core content areas begins by setting out the objective of that content area. So in the case of S1, paragraph 45 sets out the objective of the metrics requirements, and they are to enable users of general purpose financial reports to understand an entity's performance in relation to its sustainability related risks and opportunities and progress towards targets. So although readers may be able to understand the company's assumptions from the future from the report, the main objective of the requirements is A and B. So well done to those of you who got that correct. So we're going to move on to the next part of the Align module, and this is about how you can integrate disclosure requirements that you may be required to do, but are not covered by the ISSB standards. So we've reviewed all the core content areas of the ISSB standards, but the question here is, what if there are other things that you have to or want to report on? So we've already talked about the baseline, haven't we? That's the baseline set by the ISSB standards to give the global sustainability reporting language. But what if, in addition to that, there are listing requirements or policy objectives or industry standards that you want to or have to report on, or you want to or have to report information that is relevant for a wider stakeholder group than simply investors? So examples of this might be, you might find that your local jurisdiction offers incentives like subsidies for sustainable practices or other types of incentives, and you might want to report on those, or you might be following an industry standard that means that you want to report particular aspects of your sustainability performance in line with that. And of course, as we said earlier, you can build on the baseline as long as you don't obscure information required by the standards. So this is the fact that jurisdictions may also have requirements they want to ask companies to disclose on. The ISSB is working with national regulators to ensure that this is a kind of a seamless process. So they're working with them on their decisions about the timing, scope, and alignment with existing reporting requirements. So through this work, we know that as of June 2025, 36 jurisdictions have adopted, used, or are taking steps to introduce ISSB standards into their legal or regulatory frameworks. And we also have, if you're interested, on the IFRS website, profiles, 17 jurisdictional profiles that show the regulatory decisions and alignment across ISSB standards in different jurisdictions. So there are a number of resources that we give you the links to at the bottom of the screen that show you how the IFRS Foundation is continuing to support jurisdictions considering or actually adopting ISSB standards, as we've heard from our contributors earlier today. Now, in addition, of course, we saw earlier from your Zoom poll that some of you are using other standards, and the ISSB has entered into strategic relationships to support interoperability with those standards. We heard earlier that CDP has used the ISSB's climate standard as the baseline for its own climate disclosure questionnaire. We're going to come on to look at GRI. We've talked about TPT. Let's just look at the GHG protocol. As you know, the protocol is the methodology that must be used for calculating greenhouse gas emissions. And the ISSB is working closely with the GHG protocol team, both in terms of the updates to the GHG protocol corporate standards, so to ensure as much technical alignment as possible, but also on governance arrangements so that they are aligned in terms of their governance. In terms of TNFD, some of you have asked in the Q&A, what's the ISSB doing about nature-related disclosure? And there is an update on the ISSB's website saying that the ISSB is pleased to work with the Task Force on Nature-Related Financial Disclosures as it considers how it can develop materials on disclosure of biodiversity, ecosystems, and ecosystem services. Yes, so let's now look at GRI. Well, GRI and ISSB are committed through a memorandum of understanding to work together closely, to jointly identify and align common disclosures that address information needs under their distinct scopes and purposes of their respective standards. So the most important thing to notice here is that in June 2025, the GRI Standard Setting Board granted equivalence to IFRS S2 climate disclosures on scope 1, 2, and 3 GHG emissions. So they're regarded as equivalent to and satisfying the requirements of GRI 102. Now, there are some conditions to this, and they are that to provide the equivalence, organisations reporting in accordance to or in reference to GRI standards will have to measure their greenhouse gas emissions in accordance with the greenhouse gas protocol, unless there is a jurisdictional requirement otherwise, and include a reference to the location where the information for the disclosures can be found. So it's clear where the equivalent GRI and ISSB required information is being reported, and it only has to be reported once. There's also a collaboration to deliver full interoperability on the emerging biodiversity ecosystems and ecosystem services work, which we've just talked about. So as well as drawing on TNFD, ISSB will look at GRI 101. And there are some, again, governance collaborations between them, including IFRS Foundation's convening partner role of GRI's Sustainability Reporting Lab in Singapore. Now, maybe not so much for this audience, but many of you are probably aware that in Europe there's the Corporate Reporting Sustainability Directive, and that the reporting standards issued for conformance with that are the European Sustainability Reporting Standards. So again, there is ongoing work between the IFRS Foundation and the European standard setter to ensure a high degree of coherence wherever possible, and to reduce complexity and duplication for companies that want to or have to apply both of these standards. There's already been some work done on how aligned the climate-related disclosures are, and there's a high degree of alignment. You probably know that in Europe, the European standards and the directive are under review, so of course we're not quite sure what the future exactly will look like. But broadly speaking, the differences between ESRS and ISSB are to do with their different objectives and scopes. The IFRS Foundation focusing on investor needs, and ESRS much wider stakeholder needs. So finally, I mentioned for integrated reporting, I think we saw at the beginning some of you were using integrated reporting, and we know that the Integrated Reporting Council has been incorporated into the IFRS Foundation, and certainly the Integrated Reporting Framework is regarded as a complementary tool, and it can give companies using it a more holistic view of their value creation process. Now, all I'll do here is to mention that if you're interested, there is this document to which we provide a link on the slide that shows you how you can use the integrated reporting framework to help conform with the ISSB requirements. It's got a mapping tool and a getting started guide, but perhaps the most important thing to say about integrated reporting is that it's underpinned by integrated thinking, and of course this enhances the quality of a company's corporate governance. So we're now at the end of module 2, and Fiona's going to take us through a summary of it.
Brilliant. Thanks so much for that, Lois. So as we said, we're at the end of our second module of 4, and you might be thinking we're only halfway through. Don't worry, we're more than halfway, I'm happy to assure you, but module 2 was obviously where we had a lot of detail to go into there and to talk you through. So I think we do have time to do this poll actually, which I'll just run for you as well, just to wrap up this section, which was just to get you to reflect on what your disclosure objectives should consider. So what should you be trying to meet when you set out your disclosure plans here? So is it the ISSB standards? Is it the ISSB standards and regulatory requirements? Just regulatory requirements, or the ISSB standards, regulatory requirements, and other sources of guidance? And I think I see from those of you who've responded to this that you know the answer here already. So I'll end that poll and share the results. But indeed, as most of you correctly got here, of course, we should be trying to think about all of these things in a combined approach. So hopefully that degree of alignment that we're seeing across these frameworks can support that now, so that you can meet your different objectives in a combined and integrated fashion. So thanks for sharing that. Okay, so bringing that through then to wrap up this module, let's just take a minute to remind ourselves of what we've learned. So we reviewed all of those 4 core content areas of the ISSB standards. So that's governance, strategy, risk management, and metrics and targets. But an important thing I think to remember here is that these don't operate in silos. So we saw in our examples that despite having 4 separate categories of disclosures, they are all interconnected. And we also discussed how your disclosures might go beyond the requirements of S1 and S2, for example, to meet different stakeholder needs, or to meet, of course, the regulatory requirements of the local framework that you have to report against. Although I should point out that, as was highlighted by Dr. Ken at the beginning of the session, there is a high degree of alignment between the requirements that have been introduced in the national framework and S1 and S2. So much of what we're talking about today should map very closely to that local requirement. So although maybe the terminology is different as we're referring to S1 and S2 here, the content requirements of what you're asked to produce nationally are closely linked here. So you should indeed be able to satisfy those regulatory requirements using very similar approaches to this reporting that we're talking about today. But of course, when we're building on top of that baseline of the ISSB standards, maybe to meet the needs of different stakeholders or to apply those voluntary frameworks that we talked about, it's important that we make sure that we don't obscure what's material in our reporting for investors as well. Okay, so as a bit of an exercise to wrap up this module, we're now going to be thinking around some of the key gaps that we might have. So we've heard there about all of the different content requirements, and that might mean there's some areas of new disclosure for you, or maybe some internal processes and practices that you're going to need to develop in order to meet those disclosure requirements. So what we'd like to do now is just to take a moment to reflect from everything you've heard so far, what gaps are front of mind for you that you're going to need to address. So those could be, you could share with us everything that's a gap, or you could just share maybe what's your top priority that you think you need to address. So as I've said, this could be particular reporting content areas, maybe new topics of disclosure or types of information. Or perhaps it could be different processes, maybe competencies or resources that you think you're going to need internally to help you with this. So just a good opportunity to share some ideas about what those gaps might be, because you might indeed have identified something that others haven't thought of here. So always useful to get your thoughts and see what you're thinking on this topic. Great, thanks for those who've already provided responses here as well. And just as a reminder, I shared the link to Menti again in the chat, just there, one message above. And you can also access Menti using menti.com and that code on the screen there too, if you prefer. Okay, so for those of you who've already responded, so someone's mentioned the resources allocated to manage this work. Indeed, that's often something that, as we're now moving towards these mandatory requirements, there's possibly quite a significant uptick in the resourcing that you need to focus on, and maybe something that you need to carve out a more dedicated remit for. And I think an interesting trend we've seen among some companies, for example, in Europe, who've been responding to the Corporate Sustainability Reporting Directive, is really driving the ownership of sustainability reporting into the accounting division. So, often your financial colleagues very much have the skill sets already to build the right sorts of governance and controls around this kind of reporting. now we're moving into the mandatory space. So I think working really closely between sustainability and finance to understand your existing capabilities and think about where those gaps might be is a really important step to start with. And so I think that connects as well to a few things that others have mentioned here. So someone's mentioned maybe not currently having formal board oversight for sustainability risks, and indeed having sustainability reporting separate from financial reporting. So integration now, I think, is really key to get the right approach. And I think as that person's identified, having clarity over what the board have oversight for is really important. So that might be relating to just ensuring that sustainability is part of existing governance processes. For example, if you have existing remits at board for reporting or for risk management, maybe it's about having sustainability explicitly a part of those existing arrangements. But obviously there are different approaches for different companies depending on what you think suits you best. So a few people are mentioning data issues as well, which indeed is also another common area we see highlighted here. So we see scope 3 data highlighted in particular, but broader concerns as well about maybe having a lack of completeness of data. So I think that's a really important exercise, I think, as you're preparing for this, is just to do some data mapping to understand what you might already have. And we'll go on to talk about that a little bit further in our next exercise, actually, because I think what we often find is that our starting point is thinking that we don't have any of this information. But actually, when we start to explore what's available in the business, there are either processes that could be adapted to support new data collection, or maybe there's operational information that's already been collected for other purposes that can support us here as well. Okay, great. As a few people mentioning here as well, maybe needing to do more fuller risk and opportunity assessments, and particularly assessing climate risks and connecting that into your enterprise risk process. Indeed, often again, another area that needs to be tackled here in more depth. So I think hopefully some of those examples we've shared on risk management can be helpful here, and some of the guidance that we've pointed to. But often I think what's most important is to start out with, something high level as a qualitative risk assessment, help your colleagues to understand the types of issues that you need to explore here, understand what you already know about them, and understand maybe what you need to go away and assess more fully and aim to quantify in the future as well. Okay, so similarly, someone's mentioned here about the quantifying financial impact. Indeed, that's often a new aspect to this. And obviously, we talked through some provisions there within the standards that allow a little bit of time to get to grips with that process. But indeed, for material risk areas, that's something we want to be building up to in time, is to be able to quantify those and connect that to our financial reporting. Maybe someone's mentioned about communication between departments and getting good buy-in and cooperation. Exactly. So I think hopefully the exercise of the disclosure plan that we've shared is something you could possibly use to share with your colleagues to help them to see, what their role in this could be, what support you're going to need from them to deliver this reporting, and how it connects to what they already do. So particularly if you're speaking to colleagues, maybe in financial roles, actually the good thing about the S1 and the S2 standards is that they draw so heavily on that accounting landscape and the terminology that actually this brings, sustainability reporting much closer to things, hopefully, that they're familiar with, which hopefully can support that shared working and understanding. Okay, great. Lots of great points highlighted here. So I think we see some common themes, but thanks everyone for taking that moment to reflect. Hopefully useful just to surface what's front of mind for you as kind of key gaps. What we'd really recommend here as well is to go away and do a more structured gap assessment, of course. So that's built into the disclosure plan homework that we've mentioned. And there's also an SSE gap analysis checklist that is available in the slide resources. So really what's important here is to try and prioritize those gaps. So of course, some of these things are going to take perhaps multiple reporting cycles to fully address, and that's, very understandable. But what you might want to prioritize is thinking about maybe those foundational aspects that you need to have in place for your first disclosures as well. Brilliant. Thanks everyone for sharing. So I'll be passing back to Lois now to get us started on our third module, and I'll just reshare the slide presentation for that as well.
Thank you, Fiona. I was just deeply involved in one of the interesting questions the audience is raising. But let's move on now to the next section, which is the implement module. Here we go. The backbone of effective disclosure processes and practices. We're looking at implementation. So we've looked, haven't we, in our training sessions so far at what to report, but many of you have questions about how to report, understandably, and that's what we're going to look at here. We're going to look at three things: how to identify sustainability related risks and opportunities, how to evaluate your disclosures with perhaps with a focus on the judgments required in scenario analysis, and thirdly, how to integrate processes that are designed for sustainability disclosure with your other processes and practices. So let's look at identifying sustainability related risks and opportunities first. Well, you'll be glad to hear that there is guidance on this. As we said earlier, S1 asks companies to provide material information on all sustainability related risks and opportunities that could reasonably be expected to affect the company's prospects. We have a standard on climate, but what about risks and opportunities beyond climate? Well, in this case, S1 directs companies to sources of guidance to support the identification of risks and opportunities and the information to disclose about them. So first of all, S1 says that to identify relevant risks and opportunities, when a company uses ISSB standards, it must also consider SASB standards. And these are the industry-based standards, as many of you will know. So in the case of, let's take, for example, a household and personal products company, one of the things that is mentioned in the industry-based guidance is, well, how much palm oil do you use? Where do you source it from? What is the percentage that's certified through different certification agencies and so on? So that is the type of risk and opportunity that pertains to a particular industry. In addition, the company can consider IFRS educational material on sustainability risks and opportunities and the disclosure of material information. I think we gave you the link to that earlier. It was issued fairly recently and is very comprehensive guidance on this subject. In addition, you could refer to CDSB framework application guidance available on the IFRS website, industry practice, or the materials of investor-focused standard setters. Now, some of you have asked in the questions about whether, for example, climate-related risk includes risk to human health. Well, some of these other types of guidance do sort of guide you about where risks and opportunities happen in that nexus between climate and other things, so do take a look. The same things apply for when you decide what information to disclose. All of the same resources can be used, but in addition, you can look at GRI standards and European sustainability reporting standards for guidance on which information to apply. So here's an example of a process that's used for identification of risks and opportunities. So this is an extract from Ayala, which is a Philippines-based conglomerate. It's got lots of different activities: property development, diversified industries, banks, healthcare, technology, and so on. And in this process, you can see that they start with a communication and consultation exercise, whereby they communicate with a range of internal and external stakeholders to get insight into the external landscape, if you like, that informs their risk and what the current thinking of it is. The first step in their process, having done the communication and consultation, which continues throughout these 4 steps, is to establish the context within which the risks are arising. So they consider internal and external factors that apply in the context within which they operate. Secondly, they assess the risk. They identify, analyze, evaluate, and prioritize the business risks based on their likelihood and impact on the company's viability and operations, as well as on other identified risks. So we see that connection there, that wide sort of systems approach. Thirdly, they decide how they're going to treat the risk, including which people within the organizations will have responsibility for owning the risk. And finally, they set up a monitoring and review process for their risk. So this shows you how they identify risks in IALA. Let's have a look at another example now. This example comes from Nest's 2024 annual report. Nest is a company based in Finland. It's a producer of sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry. So it uses science and technology to transform waste and other resources into renewable fuels and circular raw materials. So this extract shows how the company identifies risks and opportunities in different scenarios. So they're using scenarios to inform their understanding of risk. The first scenario is the Net Zero World 2050, which anticipates rapid and radical emissions reductions consistent with keeping global warming to 1.5 degrees above pre-industrial levels. They may have a sub-scenario there which applies only to EU and North America in the net zero world by 2050. And that's because different jurisdictions progress at different rates on decarbonisation. Now, they describe the scenario, they set out the opportunities in each case. So on a global basis, they think the opportunities that they can expand into new markets and sectors. And in Europe and North America, they expect their supply of renewable and circular solutions to be supported by regulation and voluntary ambitions in this scenario. They, of course, identify risks as well associated with competition and the rate at which new technologies might accelerate. The other scenario they use to consider risks and opportunities is called the compromise climate target scenario, where climate action is slow and global warming of 2.5 to 3 degrees is anticipated. In this case, the company can take opportunities by differentiating itself from others through its supply of renewable and circular solutions. But the risk is that the demand for those products might be constrained in this scenario. Now, interestingly, if you look on the last line of each of these boxes, they give an indicative financial impact to the company, and the most positive impact is in the Net Zero World 2050, as you might expect of a company whose business model is focused on renewable fuels and circular products. So the lowest temperature scenario is most favorable to them. So there are some ways in which companies identify risks and opportunities, and we've seen some guidance to help. But of course, the standards recognise that it's still not easy, and therefore this proportionality mechanism applies to identifying risks and opportunities. The company only has to use reasonable and supportable information available at the time without undue cost or effort. What does this really mean? What's reasonable and supportable? Well, it's information that's specific to the company. Of course, that company will already know because it's specific to them. It takes account of the external environment. As we saw in the IALA example, it was their first step to look at the external environment. It includes information about past events and current conditions. Company will already know, but also forecasts. Perhaps this is what the Nest example is getting at. And in some cases, what is proportionate will be specified in ISSB standards. Let's go to Fiona now for the next section of this module.
Thanks, Lois. Okay, so that moves us in now to evaluate the next segment, as we say. So once we've identified those risks and opportunities, we're going to need to evaluate the financial effects of them. And so we do know, of course, as we've already talked about, this can be one of the most daunting tasks when we first get started. So here we're going to briefly review a few of the key concepts that could help you with this process. So to help investors understand a company's resilience against climate risk, S2 requires that they disclose information about the implications of climate change on its strategy and business model. And companies are also asked to disclose their financial and operational capacity to adjust or adapt over the short, medium, and long term. So, for example, you might test your company's resilience against new regulation to limit certain high emissions activities, or maybe your company's ability to respond to changing crop yields, for example. And so this is where you're going to need to use climate scenarios to analyze what those effects will be. And what's important to remember about scenario analysis is that you're not being asked here to predict the future. You're not asked to ascribe a certain likelihood to a scenario, for example, or to forecast which one is going to happen. You're simply being asked to explore plausible possible pathways as a tool to help you to understand the range of possible futures and to build resilience and adaptation to those different outcomes. So overall, S2 doesn't prescribe what scenarios that you should use because those are going to be unique to the company, its industry, the types of risk and opportunity you're looking at. But you're asked to use relevant scenarios and to provide disclosure about how you've selected the scenarios and how you've used them, and overall what the conclusions are from your analysis. So another example I should say here to help with this. So this one is from Nestle, the Swiss multinational food and drinks company you probably have heard of. So this is one of the outputs from their climate scenario analysis, of which there's several different ones to look at in their financial reports. But this one in particular shows us how they've modeled the potential impact of physical climate change on the yield of different agricultural commodities that they rely upon as an input to their supply chain. And so this projects the potential increases or decreases in yields that they're going to see in 2040 versus a baseline of 2022 under a medium emission scenario. And so we see that actually increases in heat waves, droughts, and water stress could affect the availability of their raw materials, which could lead to increased prices and volatility and less stability in their supply chain. And so in their disclosure, they go on to discuss the results of this analysis, the different areas of their business that they think it could affect, and the steps that they're then taking to improve their resilience in light of this. So, for example, investing in crop science to develop more resilient crop strains, looking at operational efficiencies and product innovation. And now one thing just to highlight to finalize this section is we know that when we're talking about the materiality of future events, there's a lot of uncertainty associated with that, and that can be challenging to quantify or to disclose. And so when you're making this determination on scenario analysis and uncertainties, you're asked to consider and continue to evaluate what those uncertainties are. And so this list here lists the different types of factors that you'll want to keep in mind as you continue to monitor those uncertainties. And so this is something that you need to keep evaluating each annual reporting cycle and disclosing alongside your analysis is what those different uncertainties are and any steps that you're taking to further refine your analysis here. Okay, great. Back over to you, Lois, for the final segment of Implement.
Thank you, Fiona. So we're now going to be looking at how you integrate new processes or perhaps just adapt processes into your existing systems to cater for sustainability disclosure. So here's some things that you can consider when deciding whether you need to create new processes or adjust existing ones. And the good news is that for many companies, they'll find that they already have management systems and processes that can be really helpful with when preparing sustainability disclosures. So what might you do? a gap analysis. I think some of you have mentioned this in Menti, and that gap analysis will help to check for gaps in existing systems and processes that need to be filled in order to help with your sustainability disclosure. You need to look at both whether the existing systems are suitable and have the appropriate prioritization criteria for sustainability reporting. So for example, we've already said, haven't we, that sustainability related risks and opportunities can manifest over longer time horizons than other risks and opportunities. So you just might want to check that your existing systems are suitable to take account of those time horizons, and also that the prioritization criteria cater for the specific characteristics of sustainability risk. So instead of just probability and likelihood, you might want to also have criteria on impact, vulnerability, and speed of onset. Your internal controls process can really help with sustainability disclosure. And importantly, thinking about who can help, which departments, which people, which experts have already processes and systems and practices that can help with sustainability disclosure. What are the interconnections between different internal and external factors that influence your assessment of sustainability related risks and opportunities? And what processes do you have for dealing with uncertainties? Companies are asked to disclose their uncertainties, so it's helpful to have a process in place for making judgments where you do face uncertainty about whether and to what extent disclosures will be made and what assumptions will be disclosed with them. And finally, of course, consider whether you have the resources in place to adapt existing processes or develop new ones, whether you need to go through a budget or change management process. So one thing we think that can help when you're thinking about processes and systems and how to report is to develop a disclosure plan. And indeed, this is your voluntary homework, as you'll see when you download it. A disclosure plan is not required, but can be helpful as a standalone strategy or as part of a wider disclosure strategy that covers governance and risk management and so on. And it enables you, your company, to take control of its own narrative by making sure that what you disclose is specific to your company. Can support internal collaboration, knowledge sharing, and cross-functional team discussions by recording who in the organization should be involved, where relevant processes might exist that can help, how will data be sourced, which departments will be involved, how will they be organized, perhaps through subcommittees. All these things can be recorded in a disclosure plan that then acts as a central reference point, an audit trail that can include information about where and how judgments have been made, whether and from whom assurance will be sought, what are sign-off procedures, and so on and so forth. And here's an example, not exactly of something called a disclosure plan, but an example of an extract from Novo Nordisk's annual report in which they set out many of the things that you would expect to see in a disclosure plan. So they call this the basis for preparation of the sustainability report. It explains the regulations, standards, and practices the company has had to or chosen to use. And you can see the long list of them in that second paragraph: the GHG protocol, the Science-Based Targets Initiative, the GRI, the TCFD, the SASB. They list here the standards and frameworks on which they have relied. They set out the time horizons over which the sustainability statement has been prepared, and they explain what they mean by short-term, medium-term, and long-term. They explain how they have used and made estimates. They provide information about assumptions and uncertainties and a lot of other contextual information to help better understand the data. So anybody reading their report knows the how they have approached their reporting. And you can imagine, can't you, that deciding on all these things and recording them is really helpful to do before you start the reporting year. So that's why we recommend a disclosure plan as being helpful to you. So let's do another Zoom poll. And the question here is a disclosure plan required by the IFRS Sustainability Disclosure Standards? And you can only answer one of these, either yes, and you must disclose your plan, or no, but it's a very helpful tool. I can see that you know the answer to this question. So I'm going to end the poll and share the results. You're right. No, there's nothing in the ISSB standards that says you must have a disclosure plan and you must disclose information about it. We just recommend it as your homework because it's really helpful. However, do note that there are certain requirements in the standards that tell you there are certain things you must disclose that we would expect to find in a disclosure plan, such as what sources of guidance you used, what judgments were made, what sources of measurement uncertainty you discovered. So there's no requirement for an overall disclosure plan, but there are requirements that ask you certain things we would expect to be in a disclosure plan. Let's do one more poll just to make sure we understand this correctly. What can a disclosure plan help a company to do? Just select all that apply, take control of its narrative, support collaboration. I'm sure many of you will think what a relief it was to find someone in the organisation that could help you, act as a reference point and audit trail for disclosure preparation, or to skip full disclosure as prescribed by ISSB. Great to see your participation here. And again, I can see you know the answer. So I'm going to share the results. Yes, of course, you're right. It's for the first 3 reasons. So well done to all of you. We finished module 3, so Fiona's going to take us through a summary of it.
Brilliant. Thank you, Lois. So as we say, this brings us to, excuse me, the end of module 3 of 4. So close to the end now, everyone. Well done for staying with us. We'll be finishing the session with communicate. So 40 minutes left. I think I saw someone asked a question about the timing. So well done for all of those who stayed with us through the training. We know there's a lot to cover. So to wrap up this module, just to come back to a few key things. So firstly, connections. In this last module, we're wrapping up by highlighting the importance of connections between the 4 core content areas. And then here we've really focused on making those connections between a company and its external and internal environment as well. And these connections are what we need to focus on when we're identifying key risks and opportunities. And the second thing we talked about here was relating to evaluating those risks and opportunities. And a key component of that evaluation is consistency in your assumptions. So as we've talked about, using scenario analysis can be a helpful tool, but it's important to track and disclose the assumptions and methods that you're using as part of that process. And finally, as we've seen, even if some of this data maybe isn't data that you're yet disclosing, you might already be collecting it for different reasons, or maybe you do have practices or processes in place that could allow you to start collecting the information that you want to report. Maybe you just need to make some slight adjustments to them. So as much as we can, we want to try not to start from scratch and to build on what we might already have. And that is really the emphasis of our final quick Menti exercise to round off this section, which is to think about, you maybe have identified in our last Menti what your key priorities are in terms of gaps. And I know many of you maybe identified data as a gap. So here we want to think about what gaps, what steps you could take to address those gaps. And this could be thinking around how you could adapt existing systems and processes to support data collection, or maybe thinking about the sources of information you might be able to gather internally to support your processes here. So let's take a quick look at that together in Menti again. Another question, I think, where crowdsourcing thinking can often be helpful because there's many parallels, I think, between organizations here as to what the sources of data are that you might have. So please do share your ideas, and I know they'll be very beneficial to others. So question here is existing processes or sources of data that you might have that could be adapted or utilized to support your sustainability disclosures. Someone said none, so that's a shame. I'm sure that's not true. I'm sure there's something that you have. So let's see if maybe some of the other responses here might give you a little bit of inspiration. People are mentioning here about using their HSE systems or their enterprise risk processes, or maybe compliance data sources as well. So yes, exactly. I think those are good ideas. Maybe integrating things into your ERP system to embed data collection in that route is a good idea. So yeah, that's a good system to embed requirements into. People are mentioning as well, maybe operational data sources that could help you here. So data that is talking about utilization of machinery, maybe standard operating procedures as well. Perhaps you could conduct surveys, as someone's mentioned here, on particular topics if you need to find out more, maybe surveys of your customers or investors, for example. A good one as well that people have highlighted here is about your ISO certification. So if you already have management systems certified to ISO, certainly you'll be required to have certain documentation and data collection processes there, which could help you. People have looked at historical data sources, maybe speaking to their colleagues in audit or research. Lots of great ideas here. Someone's also mentioned using AI tools as well. So yeah, definitely a good idea. And that could either be to collect and analyze data you already have, or maybe to help you with identifying good data sources or good approaches to estimating things as well, maybe where you can't yet get the real data. That's, obviously understandable that you might start with estimates to begin with. I'm seeing electricity consumption, surveys again, lots of great ideas here. So I think hopefully all of you who've responded have perhaps given the person who said that there's nothing they can use some source of inspiration here. So thanks very much. I think lots of great ideas here. And so the point I think we'd like to end on with this is, of course, that there's a lot that you can draw from here. So encourage you to really do that and to think about embedding and integrating in your processes and systems that you already have. Brilliant. Thanks, everyone. So that brings us now to the start of our fourth and final module, which I'm pleased to introduce Robert to take us through. Thanks, Robert.
Yes, perfect, Fiona. Thank you for this introduction. Yeah, my name is, hello, everyone. My name is Robert Svitoski. I'm a partnership manager at the IFRS Foundation. And indeed, I'll be taking you through the last module of this training, which is communicate. And we'll be then focusing on when and where of the disclosure of sustainability-related financial information. So with some practical tips and information how to disclose the information effectively. So there'll be 3 sections in this unit. Will be location, efficiency, and confidence. And to get us started, we'll first look at to clarify where sustainability disclosures should be located. But before we dive into the details, I want to then zoom out. I'd like to just zoom out a little bit for a moment and look at the reporting package in a holistic way. So because I think it's helpful to step back and think about sustainability disclosures, and where sustainability disclosures sit in the overall reporting landscape. So as you know, investors already receive the financial statements, and the ISB standards are designed to sit alongside them, helping investors to understand sustainability-related risks and opportunities that could affect financial performance. So together, these form the general purpose financial report. The ISB standards build on existing sustainability frameworks, but focus specifically on investor needs, using concepts familiar from financial accounting. So where the GRI standards and the multi-stakeholder standards are sitting in here. So they do play a different but a complementary role. They address broader impacts and social concerns. Although ISSB and GRIs may overlap in what is reported, the materiality lenses differ. So the IFRS, as we mentioned a few times today, centers on investors' decision-making, and GRI on broader impact. So these frameworks, what is important and to remember and to take away from this, that these frameworks are not competing. They serve different purposes, and when used together, they can help organizations meet expectations on investor decision-making, and they can help organization meet expectation from both capital markets and wider stakeholders. So, for example, double materiality assessment may reveal impacts that also pose financial materiality risks, meaning they become relevant under S1. So during our Q&A, we received quite a few questions whether S1 and S2 have a double materiality assessment in place. They do not. They have a single materiality perspective. But it's important to remember that by using GRI as an add-on, you might identify the impacts which are relevant to pose the financial material risks, and they become relevant under S1. So this is the importance to have this in mind. And moving to the next slide, and what is material information? So materiality under IFRS has a very specific meaning. A company first we just focus on the definition of the materiality here. Sorry, on this slide. So as we just noted, materiality has a different definition for different reporting standards and audiences. So let's first recap what it mean by material information for the IFRS. In identifying material information to be disclosed, a company will first need to identify the SRROs, so the sustainability-related risks and opportunities that could reasonably be expected to affect its prospects. So once the company has identified the risks and opportunities, it can determine what information to provide about those risks and opportunities. And here, the materiality definition comes in. So the definition of material information used in S1 is based on and aligned with the definition in accounting standards. And again, it is the information that, if omitted, misstated, or obscured by other information, could reasonably be expected to influence investors' decisions. In other words, ISSB seek to identify disclosures of key information that matters to investors. So the entity determines what constitutes a sustainability-related risk and opportunity based on its facts and circumstances. And as we discussed, and I'm sure entities often have well-established processes for identifying assets and responding to sustainability risks and opportunities as a part of their management of the business. So in the next section, we will look on disclosure of material information. So what investors want clearly identified decision useful information. ISB disclosures are structured to support that. So that means not everything has to be disclosed, only what is material. Even if a requirement exists in the standard, companies do not need to provide it unless it is material for the entity. So when preparing disclosures, there are a couple of matters which should be noted. So please do make material information easy to find and use plain language. You should avoid scattering information across the reports and include additional non-material disclosure only when regulators require them, clearly labeling them as such. A while ago, IFRS in November 24 established educational resource on identifying and disclosing material information, and please ado, we encourage you to review it. All right, and with this, we're going to have another Zoom poll on information should be disclosed in the annual report when applying ISSB standards if, and we have three options. A, omitting the information could reasonably be expected to influence investors' decisions. B, it could reasonably be expected to affect the company's cash flows. And C, it exemplifies the values of the leadership team. So please do select all answers which apply here. As if you are listening carefully, it should be very easy to answer this question. And I see most of you indeed answering them correctly. So in this case, the correct answers are A and B. So yeah, you should disclose the information if omitting the information could reasonably be expected to influence investor decisions, and also if that information could reasonably be expected to affect the company's cash flows. So well done to the ones who answered it this way. Right, and then we go into the next section and then answering the question, which we also received quite a few times in Q&A, where to report. So ISB disclosures must be part of the same reporting package as the financial statements, and they need to have the same timing, same report, cover the same reporting period, be authorized by the same body. So S1 deliberately does not dictate where within the report, when within the report information must sit to allow jurisdiction flexibility. So many companies still publish standalone sustainability reports, but this approach does not meet ISB standards. So, for example, WBCSD data shows that while standalone reports still dominate, there's a growing shift toward a combined or integrated reporting driven by regulation. Right, and then how to apply this in practice, we're going to have another example, and Lois will present it to us. So over to you, Lois.
Thank you, Robert. Yes, and rather than sharing one example, just going back to what Robert said earlier, the World Business Council for Sustainable Development kind of tracks where companies are reporting, and we've got this figure from their latest Reporting Matters document 2025, which is their annual review of corporate reporting from a selection of global companies. So you can see that while standalone reports remain the predominant approach in 2025, they're going down slightly from 2024. There's a shift towards reporting financial and non-financial information in the same document, in line with mandatory requirements and in line with what Robert just said, that for IFRS standards purposes, sustainability information must be reported in the same document as the financial statements. So you can see the trend over time. Standalone still dominates, but is decreasing. You can also see some of the regional differences. So these are linked to regulatory shifts, particularly in Europe. So you can see that in the region, 42%, if you see it right at the bottom there, in Europe, are combined reports, and 19 are self-declared integrated reports. Standalone sustainability reports still predominate in the Americas, representing 81% of reports, and in APAC there's a mix of sustainability and self-declared integrated reports. So do have a look at the publication. Fiona's kindly given the link to it in the chat if you want to know more about trends in where companies report. But for now, we'll hand back to Robert to take us through some information about digital reporting.
Yes, indeed. Thank you, Lois. Right, there's another important aspect about sustainability reporting or reporting in general, and that's the evolution towards digital reporting. And the technology is emerging consideration for disclosures. So yeah, corporate reporting is increasingly moving from PDF reports towards information on web pages with structured data sets, such as those databases offered by stock exchanges. The IFRS Foundation has created the ISSB taxonomy, which reflects the requirements and accompanying materials of the ISSB standard. So the taxonomy is important to remember here, does not introduce any new requirement. Digital taxonomy provides the common elements, or tags needed to make sure your sustainability disclosure is machine readable. This makes it easier to take large data sets like information from an entire industry and bring them all together to analyze them. So digital reporting has a number of benefits. It makes the reported information easy to use for analysis. Data is structured in the same way across businesses in machine readable format. Tagging information potentially allows for automated checks for quality and consistency. So more and more data collection and management systems are compatible with digital reporting taxonomies, improving processing and report preparation. Also, tags can have labels and description in multiple languages. So if you report your quantitative data in one language and someone speaking another language can also understand what it means. So that's about technology and the and digital reporting. We're moving to the next unit of this training, and we'll be talking shortly about how to communicate efficiently. So right. So first of all, it's important to understand what effective communication looks like and what is required. So often companies think if they just pull all the information, put all the information that they have into a report, and everyone will be satisfied. And this would be against the core concept, in particular for presentation. So in order to achieve this objective, it might be helpful to ask these questions. Is the information you are disclosing clear and concise? And what we mean by these terms. So clear might depend on the nature of the information. And for example, whether it could be clear to present information in tables, in graphs, diagrams, plus explanatory accompanying text. And then concise, that will be to be concise, disclosures should avoid boilerplate informations, unnecessary duplication of information, and use a clear language. So these will be the elements you should have in mind in order to communicate effectively. There is some other elements which you also need to consider. As some preparers watching today might be thinking to themselves, they still understand what is the fuss about, and perhaps you have the experience with the focuses on standalone sustainability reports, and might not have much interaction with external audit. So to the accountants watching, I'll be saying then, be kind to your colleagues, help them understand the difference in rigor that is required in data collection, oversight, sign-off processes for the financial statements. So what it means, for example, the disclosures would then include comparative information and are to be restated as necessary. So this to enable the quality of the information and to better comparison of with the previous periods. So what that also means that disclosure should avoid unnecessary duplication and cross-reference when it's required. Information has to be material, has to be connected and aggregated or disaggregated as appropriately. So these are the elements you might want to consider, and we mentioning briefly before cross-referencing, and I want to just stop here for the moment to explain this term. So You may have already noticed that there may appear to be some overlap in disclosure topics. For example, you might have the same governance approach for all sustainability issues. So then rather than duplicate certain information, you can use cross-referencing to enhance efficiency of your disclosure. So cross-referencing to other reports is permitted as long as the other report is available on the same terms at the same time as the sustainability disclosure. The cross-reference information is assumed then to become the part of the reporting package which we discussed before. So cross-referencing shall be applied consistently and transparently, should not result in information becoming more difficult to understand. And the best way to understand this indeed will be to see in an example, and Lois will have another one. So over to you, Lois.
Yes, thank you, Robert. Just a very simple one here. This is from the multinational steel producing company ArcelorMittal from their 2024 report, and it shows what cross-referencing and navigation can look like. There's lots of different ways of doing it, but very simply, the company has listed in the left-hand column the content elements that you're now all very familiar with. You can see governance, business model, risks and opportunities, strategy, etc. down the left column. And all they're doing is showing you in the right column where you can find information about those content elements. They're cross-referring you to where you can find it. So just a simple thing to note, sometimes they're cross-referring you within the report. So this is the sustainability report extract, and they're saying under governance, see governance and risk management in this 2024 sustainability report. And in other cases, they're cross-referring to an external report, as Robert just mentioned. So in risk and opportunity, there's some information in the sustainability report, but for more, they're referring people to the Form 20F, which is a US required annual registration document. So cross-reference within and to other reports that we see there. So back to you, Robert.
Great. Yes, perfect. Thank you, Lois. Right, we're moving to the next important consideration, which is we made to support the adoption. Very briefly here, so the ISSB included several design mechanisms to support preparers. So first of all, terminology and concepts familiar from the IFRS accounting standards, as we mentioned a couple of times. Secondly, there are number of proportional application. So acknowledging different capabilities across companies and the different maturity levels. So to enable the application of the standards also for the less resourceful entities. And there are also a number of reliefs in the first year, and these include the reporting only climate, so S2 in year 1 of your disclosures. Secondly, allowing sustainability disclosures with half-year reporting, so allowing you more time for the sustainability disclosures than for financial reporting. There is also a relief from scope 3 and some greenhouse gas protocol requirements in year 1 as well, and not needing comparative information in the first year of reporting. And there are a number of other supporting resources, include SASB standards, CDSB guidance, and the growing set of IFRS educational materials, which you'll find out on our website. So this mechanism are intended to help companies build high quality practices over time while jurisdictions determine when to mandate adoption. So we will have a couple of examples now to check your knowledge and understanding of the information we just covered. So the first of the two is the question is information disclosed in accordance with the ISB standard should be, and there are 4 options here. Please do select all which apply. So A, decision useful, B, material, C, misleading, D, comparable. And I'm sure this is pretty straightforward for the audience today. And I see most of you already took part in this poll, so I'm going to end it up right now. So of course, information disclosed in the standards, in accordance with the standards, should be decision useful material and comparable. It should not be misleading. In the next Zoom poll, we're going to have another questions which then states information in is decision useful if it is, and 5 options here: relevant and faithfully represent what it proposed to represent, B, comparable, C, verifiable, D, timely, and D, E, understandable. And then if you were listening us carefully, I think that's also easy to answer. So all 5 are the elements of the useful information. So A, B, C, D, and E apply here. So again, well done to ones answering this way. Right, and now we're moving to the very last unit section of this unit. We called confidence and how to maximize confidence in disclosed information. So trust trust in disclosures is essential, especially aiming rising concerns about greenwashing. So comparatives help investors see trends and progress and the effect of strategy and risk management decisions. So when estimates or methodologies change or if there are material errors, comparatives must be revised or restated to preserve decision usefulness. ISB standards include relief for commercially sensitive information. So companies do not need to disclose sustainability-related opportunities. It's important here. That's about this commercially sensitive information relief. It only relates to the opportunities, not to the risks. So they don't need to disclose information about these opportunities. Where doing so would harm competitive advantage of the company. And then finally, confidence is strengthened through a clear statement of compliance. So a company that complies with all requirements, including available reliefs, must explicitly state that if complies with the ISB standards, ISB there's a guidance published in the September 24 volume called Voluntarily Applying ISSB Standards, a guide for preparers, and this guideline explains how to do this in detail. All right, and then on this very last slide in this unit, and there are a number of things to remember. So by summarizing key principles, you should focus on material decision useful disclosures, should communicate clearly and efficiently, use cross references thoughtfully, maintain consistency and rigor, and use the available guidance and reliefs which are listed in the standards. And there are additional reminders and examples in the handout slides. So please do refer to those later on. And with this, handing over to Fiona, which she should provide a summary of the module 4. Over to you, Fiona.
Thanks, Robert. Apologies, just getting my camera to refocus there. Excellent. So that brings us to the end of our final of 4 modules. So before we wrap up, we're going to take a quick moment just to recap on what we learned here. So firstly, we discussed where to report information. And what was important here was the audience. So who are we reporting to? So making sure to be clear from the start who the primary user of information is will help us to ensure that that information is right for their needs. Robert then talked to us about efficiency, and I think a key takeaway here is that less is more. The objective is not to overload investors with information, because actually that can be harmful given it could obscure the information that's required. So using the standards as you get started can be a good guide to make sure you're providing what information that investors need, which of course is the purpose of the ISSB standards. And finally, we then discussed report user confidence, and especially in the current climate where there are greenwashing accusations and potential legal ramifications from that, we want to ensure that our data is not only accurate, but that it's presented in a way that builds confidence and trust among report users. And so that's where the disclosure plan that we've been discussing can help you to do this, because if it's done well, that plan will give you a clear and documented process for reporting the data that investors need. Okay, so to wrap us up on our final area, we have another quick activity together. We'll keep this one short in the interests of getting you away to your evenings. I know it's a little bit late in the day for everyone, so thanks for staying with us. But we've heard a little bit here about navigation techniques and presenting information. So just take a moment to share in the Menti any particular tips or ideas that you might have about navigation techniques that you find helpful, maybe when you're reading other organizations' reports, or ones that you've found to be particularly effective for your organization as well. And that's always useful just to have a sense of those. Great. So I see people mentioning cross-referencing, using diagrams, color, having clickable tabs. Yeah, I like that one too. Maybe having an executive executive summary and using a clear structure with a set of headings. Using infographics and hyperlinks. Yeah, excellent. I think all the sorts of things that we would recommend there as well. Having a clear table of contents and that navigation pane idea, and thinking about that digital reporting element that Robert mentioned too. So not just having a PDF, but thinking about digital interactive reporting. Thanks everyone for the quick share there. So I'll move on to the final Menti question for you, just in the interests of time, which is just to come back to that question we asked you at the beginning of the session. So if you remember, we talked about where we were in our current understanding and comfort on those 3 areas. And I think we were somewhere in the 2 point something overall in our comfort and understanding. And thanks for those who've responded again. Now it looks like we're seeing some higher scores here that are a little bit over the midpoint now and a little bit more comfortable. So that's fantastic to see. Of course, we aren't able to cover every aspect of this in today's training, and really what we want to do today is just to help you to understand where you should go for more information, that you've got the key principles and you know where to look to understand more. So hopefully we've helped you with that, but we know that there's a lot more to learn. So it's a continued journey, and that's, I think, as well, where we want to share with you a few resources now just to close out the session that can help you to continue that journey. So firstly, just to mention, as I've said again, as a final time, the homework assignment. So the purpose of this homework is to help you develop that disclosure plan for your own company. So to put in practice what you've learned today and to take this forward with your colleagues. So you can find that disclosure plan homework on the event page for today's session in the resources section. And as a final reminder, you'll also find there the slide presentation from today, which includes hyperlinks to all of the guidance and resources that we've discussed. And also the recording of today's training will be posted there later in the week. A few other resources just to mention in closing as well. So the IFRS Knowledge Hub is a great resource to go to for all of the materials from the IFRS Foundation. And they're continuing to update that all the time, sharing other organizations' resources and guidance as well. So a great place to go for some further case studies, good practice guidance, and the webinar series that the IFRS run. The IFRS team also have developed 4 free e-learning modules to support adoption of the ISSB standards. And so these are self-paced, interactive knowledge checks with CPD certification as well. So those may be useful to strengthen your understanding a particular aspect of what we've discovered today, or also to share with colleagues as well. And then, as Judith from the World Bank mentioned to us at the start, the IFC, our partners on this program, have a great resource in the Beyond the Balance Sheet program. This is a real toolkit of different resources that can support you, including further e-learning as well from the IFC, which is freely available if you register for an account with them. So encourage you to take a look at those different resources there. There's a lot of focus, I think, in the IFC's materials on really how to embed these things into corporate governance and other processes, which can be very valuable. And a quick final reminder as well of the SSE toolkit, which we mentioned to you at the start, and you can access that within the handout. And now I see the questions starting to come up, which I know is front of mind as we get to this point of the training, which is how to get your completion certificate. So firstly, just to say a big well done and thank you to everyone who's still here with us after 3.5 hours of training. We know that this is a long time and there's a lot to learn. So we're really appreciative of your engagement and the questions that you've asked us throughout today's session. So the way to get your certificate will be to fill out the feedback survey and using the link that Lois has just shared with you in the chat. So if you missed that link in the chat, it's just there, but we will also send this via email. So you'll get an email tomorrow from Zoom, which will share that link with all participants again. So of course, we'd love to get your feedback on the training itself as well through that survey. So please do share your thoughts with us. But once you've filled out the feedback survey, we'll use that to send you your completion certificate. So your certificate should come out to you within the next week. If you're missing it after that time, make sure to check your junk or spam folders in case it might have gone there by mistake. And otherwise, you can contact the SSE team at the details at the end of the presentation if you haven't received your certificate. And last but not least, as we're closing out, I'd just like to end with a few final thank yous. So firstly, a big thank you to all of the SSE official supporters who continue to help make this work possible. And if that's something you're interested to know more about, feel free to contact our team as well to hear more about that. And in particular for today's session, a big thank you to our partners at the IFC and the IFRS Foundation, particularly to Vanessa and Robert for joining us today and for helping to answer all of your questions. And finally, of course, thank you to Bursa Malaysia for hosting us and bringing us together in today's session as well. And last but not least, a big final thank you to all of you who've joined us. We really appreciate your time and participation in the session and wish you all the very best of luck with your implementation of these standards and an enjoyable rest of your evenings as well. So thank you very much again, everyone, and we'll close off the session there. Thanks very much.